Good morning, everybody. Starting a little bit late, so we'll try and catch up, I think, during the course of this panel. Easing into the morning with a fairly straightforward topic. Globalization after neoliberalism, failed progressives and Trump, a global system for financing for development, climate change, and prosperity. I think my job is mainly to introduce the failed progressives on this panel, which I will do in a second. I will introduce myself as a failed progressive first of all. My name is Richard-Kozul, Wright. I'm currently between SOAS in London and Boston University with Kevin. But I guess the qualification for me being on the panel is that I spend most of my professional career at the UN, largely in UNCTAD in Geneva. We celebrated our 60th anniversary last year, and a lot of the qualities that I think have been talked about with IPD, and my congratulations, of course, to Joe for this anniversary session, are qualities that I think were closely associated with UNCTAD as well. The importance of research-based, policy-driven research, a degree of independence, but also an outlet through, in our case, through a UN architecture to present reforms to the multilateral system from a development perspective, which was the raison d'etre of UNCTAD when it was created in '64, and with a very prominent figure in charge of it. We had IPD had Joe, of course. UNCTAD had Raul Prebisch, a similar kind of activist intellectual that created UNCTAD 60 years ago. Despite our acronym, we were not a trade organization. UNCTAD was never established as a trade organization. Prebisch himself was a central banker, and finance was critical. And as with Joe's work, the interdependence of trade, finance, technology, and understanding those connections and refusing to be squeezed into silos with what UNCTAD really was all about. And today's topic, I think, has always been part of the UNCTAD agenda, and with some successes that we're going to talk about the role of SDR in development, I think, both in this panel and the next. UNCTAD was the institution that was responsible for universalizing SDRs back in the 60s. It was originally intended as a tool only for developed countries. It was UNCTAD that universalized that. The 0.7% aid target is an UNCTAD target. New windows, financing windows in the IMF, although we didn't really get much progress there with respect to commodity producers. Creating the G24. UNCTAD we spent 20 years trying to reform the system that we inherited from the Bretton Woods era, culminating in efforts in the new international economic order to really fundamentally change the rules of the game, the way Joe has talked about, I think. Failed in that endeavor, of course, and moved from being a progressive reformist body into essentially becoming a critic of the system that eventually succeeded, and whether we call that neoliberalism or the Washington Consensus or finance-led globalization, we became critics rather than reformers. It's not an easy place to be a critic, going against the current orthodoxy, and to have someone like Joe to turn to as an authority was incredibly important for the kind of work that we were doing in UNCTAD from the early 90s onwards. And we do have a lecture series in honor of Raul Prebisch, and Joe gave the Prebisch lecture in 1998. We're still a World Bank economist. So to have someone from the World Bank come on and essentially criticize the Washington Consensus and look and suggest we needed alternatives was incredibly encouraging for the kind of work that we were doing in UNCTAD around the Trade and Development Report. And so, we really appreciated that, Joe, as people trying to maintain a kind of developmental tradition within the multilateral space that was losing traction, I think, in many respects. And I think the issues that we've talked about, precisely the kinds of issues that we'll talk about panel. Gabriella gave us a bunch of very detailed questions, which would be a conference into themselves, really. And I'm not going to follow in great detail the questions. I mean, essentially, what I think we want to talk about are the fundamental flaws in the global financial system as it currently operates, and the particular flaws as it refers to financing development and the climate challenge, and also what kind of reform agenda we need, what kind of reform agenda we can actually achieve, which are not the same things, of course, and UNCTAD for 30 years has found that out in the hard way. It may well, I mean, Branko in his last Substack talked about the dangers of an unhinged discourse in which the reformers of the multilateral system are not really taking into consideration the reality on the ground. And we've always got that danger. And I think we need to talk about alternatives to the multilateral system too when it comes to forging international cooperation in the areas that we think are going to be reformed. And I guess there's no better person to introduce the topic than Jose Antonio Ocampo. He thought he was going second, but he can't go second. I'm not going to introduce him. You all know him both in the IPD, and I obviously know him from my experience in the United Nations in Geneva and New York. And of course, he has a very impressive career as a politician in his own country. So I think you're best placed, Jose Antonio, to talk about the kind of challenges that we face in this context.
Is it okay? Okay. Thanking Joe. Actually, as many of you, he was my professor at Yale University. But then we had the opportunity to start working again with him when he was the chief economist of the World Bank. Actually, I brought him to Colombia for a meeting when I was finance minister at the time. And later on in the United Nations, actually when IPD started, we had some joint activities, and then he was the one actually who recruited me, in a sense, to come to Columbia University. And it has been a great pleasure. And I was the co-director of IPD for, I don't know, a bit more than a decade. Anyways, and we had very good things here. That's when I met Charlie. Although I brought her to the United Nations. But anyway, let me start by making just a few remarks basically on the financing for development processes, which started in Monterrey in 2002, and we just had the fourth in Sevilla, in Spain. And it's let me emphasize in particular the last one. And I would say the most important achievement of that, or the compromiso de Sevilla, as it was called, was a nice choice of the Spanish government to use the word compromiso in Spanish, which means commitment. Not, it doesn't mean compromise. So the Latin origin of the word is the same for English and Spanish. It has totally different meaning. And I think that's why Spain chose the Spanish. Compromiso, commitment. Anyway, I think the most important achievement in that declaration, in that agreement, was actually the development banks. I think both multilateral and national, because the document has a lot of emphasis on domestic policy of different sorts. So I think that's a really major achievement, to increase significantly the resources of the multilateral development banks on the one hand, but also support the development of national development banks. And I think the action in that regard is going to be interesting to see to what extent many countries had bad banks, let's say, in the past, and I think they should, many were eliminated, and they should be brought up again. And very importantly, also in the document is the emphasis on private financing, so that in order to be able to to complement the public sector financing. Anyway, so that's, I think, a very important point. Now, I will perhaps add the fact that there are some issues in development banks that were not emphasized and enough. First of all, the counter-cyclical role of development financing, because for developing countries, private financing is pro-cyclical, clearly pro-cyclical. So the role of counter-cyclical has been done mainly by the World Bank, but it should be done by the whole development banking system. One of the advantages of the development banking system is that it's really global. So aside from the World Bank, we have regional development banks all over the world, and we also have the two new banks, the New Development Bank and the Asian Infrastructure Investment Bank. So that's one of the advantages of the system. I'll come back to that because the monetary system doesn't have the same. And the other is the instruments. I think aside from credit and guarantees, for me it's very important to have development banks and the national level doing in a case equivalent of venture capital funds in order to support the creation of new firms, particularly in the areas of involving technological change, which my own experience in Colombia is actually that one of the very good, very nice things are the young investors. Impressive. They have lots of initiatives, etc. It's actually supporting young investors is for me a very peculiar issue. Now, in the international monetary system, perhaps the document was not strong enough. Let me emphasize, of course, the emphasis on the use of allocation and broader use of SDRs as one topic. In my view, in order to be able to a broader use of SDRs, going back to literature of the 1970s, let's say, I have always emphasized the need to eliminate the dual accounting, which was a very funny result of the fact that France didn't want to join the SDR system. And so they have to have two accounts. And that's why the SDRs are basically accounting, we have like $800 billion totally useless. So I think there's a lot of money there to be able and to use it for development purposes. Let me also perhaps emphasize the importance of the contingency facility, which has been one of the innovations, the flexible payment being the most important, but many others, because I think those contingency facilities are the best substitute for the need to accumulate foreign exchange reserves that developing countries have. One proposal that the expert group that we had in the preparation of this process that was not adopted, but I think it's very important, is the possibility of the IMF intervening in the bond markets of developing countries or emerging and developing countries during crisis. Something similar to what the Fed and the European Central Bank did after the 2007 crisis. So in order to help to stabilize those markets, because they are very procyclical. That's the and I would like also the need to think of regional, of a stronger regional system, something similar to the fact to what we have in the world of multilateral development banks. In that regard, I think the only really good mechanism of system is the Latin American Reserve Fund. But the Shanghai is partially a substitute, and that's it, because the Arab is really not a monetary fund, let's say. So we really need a system similar to that of multilateral development banks in the international monetary system. I think that has to be one of the things to promote. Tax cooperation, the document basically support the ongoing process in the United Nations for the convention, including the two major objectives, which is to have a fair taxation of multinationals on the one hand, and a higher taxation of the rich. Anyway, a big question mark is the institutional mechanism for tax cooperation. Formally it's the OECD now, but that's not a good framework. I have always supported the idea of a UN body. I hope that's part of the convention, the decisions of the convention. Let me say that one area in which everything was, and I guess Charlie will talk about, is debt, in which the decisions were not very strong, call it that way. So it's a process that has to be negotiated. And I think the best mechanism in that regard will be a United Nations Convention on debt negotiations as the mechanism for that purpose. And let me finish with institutional issues. In my view, I mean, we have this issue of who is going to, what is the global institution that will be charged on debt and on taxation. I mean, those two issues. In the case of debt, I don't mind if it's the IMF, as it was proposed in the century, so long as the decisions of the dispute settlement body, let's say, in that case, are totally independent of the IMF. That's something like the way the WTO dispute settlement worked in the past, because now it's inoperational because of the opposition to that body. But anyway, so those two institutions, debt and taxation, have to be created. And I will emphasize again the need for a regional network in all the areas of international financial cooperation. Something that we have in the case of multilateral development banks, but we don't have in the other areas. And finally, the issue, of course, of voice and participation of developing countries in the Bretton Woods institutions, which is a whole topic, in which I think, of course, the capital shares have to be updated, at one point. But I particularly support the idea of increasing basic votes in a significant way, because the basic votes are the votes that the poor and the small countries have in the decision-making bodies. So I really think it's important to have a significant increase in basic votes. In the last reform of votes, they were increased, but still very far. My estimate is that, for example, in the case of the IMF, they're only about half of what they were agreed at Bretton Woods. So it could be double and just going back to the Bretton Woods agreement. Okay, thank you very much.
Roberto, I think that's a lot of issues I think we will have to return to, particularly the issue of debt. And I should say, certainly the work that we did in UNCTAD and debt relief in UNCTAD goes back to the mid-1970s, the first attempts. But again, the work that the IP did, the work that Martin did, and our work with Martin in trying to get some rationality into the system was very important in what we were trying to do. But I guess I'll turn now to Shari Spiegel. Shari was introduced to most of us yesterday. I don't think she needs much of an introduction. I do. It's interesting that something I share with Joe, that we both hired Shari. I hired her to join the UN, and you hired her to become IPD. So that's something we share. And now Shari is the director of the Division on Finance and Development in New York. And on the cutting edge of these issues and challenges, and having just come through the severe conference, maybe you could give us, cast some light on where we stand and where the challenges really are.
Great. Thanks so much. It's very exciting to be here 25 years later to see that IPD is still going and that these conversations are continuing and hopefully influencing policy. We'll talk about that maybe at the end as well. And of course, to be here, I met Jose Antonio at IPD. I met Mary Lou at IPD. And as Richard said, I didn't meet him here, but after Jose Antonio pushed me in the direction of the UN, Richard brought me to the UN. But really excited to be here with Joe and with IPD and to see what's is continuing. I started by looking at this long list of questions that came to us which was not surprising for me to have a long list of many, many, many issues, which could be, which is at a whole conference. But what was interesting, and which actually reminded me of, I said yesterday that we had 15 or so task forces. It would be just walking down the hall, Joe would walk by and say, oh, I think tomorrow, in 2 weeks, we really need to have a meeting on debt, on sovereign debt. We need it quickly, so please make it happen. And we're like, okay. And before we knew it, we had 15 task forces on a whole range of issues. The first questions, though, that were on this list were, what are the key impediments to getting capital resources from savers to those needing funds? What are the fundamental flaws in the global financial system? And why has that become a recurrent problem in developing countries? And it just occurred to me those were probably the first 3 questions we looked at 25 years ago as well. And the first task forces were the capital market liberalization task force that Joe talked about yesterday, as well as the sovereign debt task force. And going through those very issues, I initially thought, okay, I'll go through a lot of the different market failures. I don't think there's any reason to do that. Certainly not in this group. But to just note that that the same market failures they're still continuing, as we all know, and in fact they are greater today. So in a sense, I thought it would be worth maybe going quickly through some of the big changes since 25 years ago. We talked a lot about quite a few of the big structural changes yesterday. Bruce Greenwald talked about some of the global growth issues, though for developing countries as a whole, global growth has fallen from 6% on average before the financial crisis to 4% annually now. To note also that and of course it's fallen by about 0.5% for developed countries. Of course, there's been rapid technological change, though of course that is also localized in certain areas, and that there's, as yesterday was talked about, demographic changes as well, and as well as entrenched inequalities that probably are very linked to some of the geopolitical challenges we're having in the pushback on multilateralism. In terms of financing flows, investment has fallen over the past 24 years, particularly to developing countries where gross fixed capital formation, again, is below the financial crisis levels across all developing regions. Domestic resource mobilization, which Jose Antonio mentioned, increased in the early 2000s, but has been mixed since then and falling in many of the poorest countries, in large part because of tax evasion and avoidance, and also linked to some of the digital issues as well. We know that official development assistance is also falling now after increasing as well. And on the debt side, there are, 25 years ago when we were talking about some of the debt issues, it was Wright post-HIPC, or it's still HIPC was an MDRI. And so the focus was really not on the immediate cost of servicing debt, but more on the big architectural issues. And the debt task force looked at those issues and tried to talk about not that as when we think about market failures and the market failures that Joe talked about yesterday in capital market liberalization, including the issue of missed markets, of incomplete markets. Certainly on the debt side, the lack of an efficient bankruptcy regime is part of the inefficiencies. But the work that we did back 25 years ago was also looking at how different types of frameworks affect the market for sovereign debt and the cost of sovereign debt, as well as the amount of issuance and the amount of sovereign debt. And today, of course, there's now the additional issue of thinking about the immediate cost of financing and the immediate cost of debt service, where I'm sure you've all heard the numbers of 3.3 billion people living in countries that pay more for debt servicing than health and education, as well as, I think there are around 25 developing countries that pay more than a quarter of their budget for debt servicing, and countries that we work with that pay over 70%. So this question of how does one address the cost of borrowing to ensure that there's space for investing is very much back on the agenda, which brings to the question of debt relief, et cetera. The other issue that in terms of the big changes that have happened, of course, the other big issue is the issue of increasing in systemic risks, and particularly climate risk. That wasn't an issue we talked about 25 years ago, but also disasters linked to climate risk, as well as pandemics, as well as increased recurrence of financial integration and financial risks as well. And so, and that, of course, brings to this question, I think it was really the climate issues that brought to the fore as we move, as we're in a period. Well, let me take a step back. In the middle, between 25 years, 10 years ago, we had the Addis Ababa, the third International Conference on Financing for Development in Addis Ababa. And at that point, there was a whole discussion, many of these issues, the thought was, how does one fix the regulatory system? And so there was a lot of discussion. For example, right before Addis Ababa conference, we had several meetings on credit ratings. And the questions on credit rating agencies was, how can they be better regulated? How can they, the architecture, the conflicts of interest be addressed, and et cetera, the structural issues. And I think that as we move towards the conference in Sevilla, there's this realization that 25 years, or that 15 years after the 10-year conference, or 10 years after the Addis Ababa conference, that the pushback against that the regulatory changes did not happen. To the extent that they happened, they were very small, and they were even walked back in some cases, and that the likelihood of more regulatory changes, especially right now, in a period where we may see more deregulation, is very unlikely, an enormous pushback. So then brings up this question of when we're thinking about what solutions, there's this, as Richard said, there's what should we do, and then there's this question of what can we do. And so, so this was a big part of the thinking as we went into the Sevilla conference, was what's actually politically, what can we do? So it was a big discussion on regulations, and it continued, but at the same time, there was also thinking about what else can be done that can actually with a greater chance. So for example, on credit ratings, yes, there's a sentence in there about regulating, but it's not taken very seriously by anybody, because if there was no additional regulations on credit ratings, after they basically brought down the entire financial system in 2009, then how, with mispricing of mortgage-backed securities, why would we expect there to be a big change in regulation? So I think that that's one of the issues that was part of it. The second set of issues that I think that a really big change was when we think about climate investing in the energy transition. When we talk about the $4 trillion financing gap every year that everyone's thinking about how to fill, a big portion of that is the climate transition. And when you think about the climate transition and trying to fund that, that's when this question of the role of private finance comes in, and probably also why there's such a more willingness to accept industrial policies, to be speaking about them from some of the big developed countries, is because of the realization that the question of, 2 minutes left. Okay, so I'm going to skip this. Right, no, that's fine. Just to say that I wanted to end up talking about a little bit about the Sevilla commitment. I think that one of the, as we discussed in the negotiations leading up to the conference, one of the points that I wanted to bring up was that there was a real emphasis, at least in the teams within the UN system, on how do we link the discussions happening in academia to this process, to make sure that the political process is influenced and is based on the latest. 5 minutes. Richard, 5 minutes. Oh, okay. So Richard, you scared me there. Okay, so, well, I'm just going to jump and skip what I was going to skip anyway. It's Mary Lou's going to talk about climate finance. So one of the main goals, the thinking was, how do we ensure that this latest thinking that's happening in the academic world comes into the political process of the UN? And so the first thing we did was we created with Spain a committee of experts that was led by Jose Antonio. Joe was part of the committee of experts, as was Jayati, and maybe some of the other people, I don't think in this room, but, and so the other thing we did was we created a series of work streams on across the different issues of what was then the Addis Ababa Action Agenda, again to try to bring in the thinking from the world and the latest thinking to influence the political discussion. And it's something we want to continue going forward, though there are a lot of challenges to that, including the cuts happening at the UN right now. But that's certainly a goal, is to make sure to think about what is this link between the academic thinking and to make sure that it comes to the political process. In terms of the outcome, we put the solutions into 3 clusters. Four clusters really. The first cluster was on domestic resource mobilization. I think Jose Antonio very clearly laid out where we are with that with the UN process as well. The second cluster is on development cooperation, where the questions are how, in a world where, going into the conference, we wanted to be very clear that we weren't going to turn the world around completely, and that if countries were cutting ODA, development assistance, to put money into military spending, we weren't going to be able to change that in the conference. So, but the question would be, what could a conference do? And so the idea was to say, what about the architecture around development cooperation? How do we safeguard ODA to make sure it goes to developing countries, the concessional finance that is there, and how do we reduce fragmentation, et cetera? So there was a lot of thinking on some of the architectural issues surrounding that. The third big cluster is the cluster on investment, which, as Jose Antonio mentioned, a big part of that cluster was the focus on development banks and on public banks. I'll say that going back to IPD 25 years ago, one of the other first task forces we had was on privatization, and it was really about the role of public versus private ownership, and the role of public versus the private sector. And many of those things in the privatization book, I actually looked at it before coming here, are still very, very relevant to the thinking and would be very helpful to bring it back to the discussions we're having today. But I think that, as Jose Antonio said, there was a big emphasis on the role of development banks, and not just the role that they play, but the role of how they work together as a system. And so, and in fact, in 2015, we brought development banks into the discussion in the Addis Ababa Action Agenda, and brought in national development banks into the thinking on a global conference and a global discussion for the first time probably, or the first time in a long time maybe. And afterwards, we got a call from one of the big development banks saying, we didn't notice that there was all this stuff about national development banks there. That's like, how did we let that get by? And so now, but it was just the beginning of the thinking. And that 10 years later, I think there's a really big, the fixed coalitions, the Finance and Commons coalitions summit came together, and this question and thinking about what is the architecture around the development bank system to make sure that the role of the national development banks, what is the role and how do they work together as a system with multilateral and regional and global development banks as well. And so that's a big part of the thinking, including in questions of project pipelines, et cetera. Who should be helping to source projects? It should probably be those that are closest to the government, which brings in the question of the private sector as well. So we all know that the private sector, that private investment, I mean, it's the question of what their role is very much a part of these discussions. You know, some of the civil society felt that there was too much of a focus on private sector in the conference. I disagree. I actually think that there was a very honest understanding that the private entities will focus on profit, and that's it. And they actually were saying that very clearly, that that's really all they care about is risk-adjusted profit. And so then the question from the public side is, when you bring public and private together, and I know that blended finance has become something of a dirty word, but I think one of the questions is, rather than it being good or bad, is how does one use it properly? And as we talk about industrial policies, thinking about bringing in public funds to support private investment is very much part of this discussion. It's just the question of who gets to say where that money is going. What is the role of the government? Is it linked to the government's industrial policies? and to their national plans? And how do we ensure that link to make sure that this is led by the governments and that it's linked to the national plans? And then as well, how does one think about, and this came up in yesterday's discussion, to structure deals so that the government has a role in the upside as well, so that the government is able to not just subsidize the private sector, but to be able to have the returns from the private sector. So just like somebody said yesterday, when the issues of Intel came out, I was sitting there looking at that saying, well, that's very much what we've all been saying, that the public sector should be getting a return on their investment in the private sector. But of course, the question is how that's done and how it's done in a way to ensure that there's no corruption and to make sure that it's in a program, as Jose Antonio said, something like a venture capital, but in a very structured way to do this. So I didn't get to debt at all, but I guess that's for me.
Sherry, thank you. I do think we need to come back to the discussion of public-private. I mean, the public-private partnership story at the heart of the billions, trillions agenda has clearly not delivered in the way that was promised or hoped. And what went wrong and what needs to come into the story to kind of either make it work better or supplant it. I mean, in the work that we've done at the EU on public partnerships, I mean, you know, the multilateral financial institutions at the end of the day are public institutions, and the need to find better relationships between those institutions and national development banks, I think, is a real topic that needs to be investigated.
If I could just say two words on that. First of all, the billions to trillions agenda, even the World Bank coined the phrase and stopped using it. So I think that's a good step. The second is that I completely agree with that. And that's, in fact, one of the goals of bringing the academic thinking into the processes right now, is to think about how do we utilize for example, the SDG investment program, how do we utilize the mechanisms, the platforms we have at the UN to have those conversations? Because even if you look at the blended finance numbers, which are really low, a big chunk of them are public to public. They're not even including those in the numbers they're saying for blended finance. So.
All right, maybe we can get back to this. Final speaker, I mean, is Mary-Lou. Jose Antonio talked about the governance challenge, and Mary-Lou, you know, was running one of the few governance innovations that the Bretton Woods system actually threw up in the last 50 years, which is the creation of the G24. And Mary-Lou was in charge of that. And so, as well as working closely with Joe, of course, when she was working at the World Bank as well. So Mary-Lou, I think, you know, we haven't talked about climate yet and climate finance, and that I know it has been an important part of the G24 mandates. We can't ignore it, given the state of the world and the challenges the developing countries face on both the development and climate front. So maybe we can pick up that thread.
Thanks very much, Richard. It's really a privilege to be part of this panel of people who have been or are in the UN system. I worked with the World Bank years ago, which was created at the UN, and the G24, which was created by G77 members of the UN. So I guess I'm a relative of sorts to my fellow colleagues here. So let me just first start thanking Joe and IPD for the invitation to join you in this anniversary. As Joe mentioned yesterday, I had the great privilege to work with him in the preparation of the East Asian Miracle at the World Bank, where we will work mostly on financial sector issues as it pertains to industrial policy. And then after the World Bank, I joined the G24, and guess what? I sought out Joe, who was a very strong voice on key issues that the group, this developing country group, were putting a lot of priority on. And I look it down so I don't forget anything. The key ones were sovereign debt, IMF surcharges, and Martin, you were part of that. and international tax cooperation, at least the key ones that I really thanked Joe for his support. Now, and I can only thank him for his engagement. I was also grateful to Joe when he spoke to our G24 ministerial meeting in 2018 and spoke about multilateralism and development, which in hindsight is really a timely topic. And I have never seen our ministers that eager in any of our ministerial meetings as that meeting. So now to the IPD co-presidents and staff, past and present, I won't name you all. I have really appreciated working with you at some points during my career. Thank you. So now, as Richard said, let me try to add the climate financing dimension and its implications in the global system for financing for development. Now, as you know, in 2015, the Paris Agreement agreed on climate goals, which by implication will really require enormous investments in climate actions globally. Now, the solution set is not only at the national level, it also involves collective efforts, given the goal, to decarbonize, improve technology and regulation, and ensure sufficient financing for climate mitigation and building resilience to climate risks. Now, but for most developing countries, and that's quite clear at the Group of 24, that investing at the scale needed is simply too difficult and complex. Governments need to take the lead, but most are facing really highly constrained fiscal prospects. Growth prospects are poorer than before, and borrowing from financial markets remains very expensive and unpredictable, and external development financing is inadequate. And many have little protection. Many climate vulnerable countries have very little protection from external shocks, including from climate risks. Now, that's just to say that climate change, addressing climate change, really reinforces the impact of the flaws of the international financial architecture. And there is no emerging global system, as of now, to really help countries deal with the financing of the investments needed to address the climate challenge, so that they can do so while maintaining fiscal sustainability. Now, taking on more expensive debt is not the solution to some extent, but existing sources of development financing are highly constrained to bridge the financing gaps. Now, so the question I'm posing and adding to the list of questions is what might be collective options that could be pursued out there by countries to increase the availability of affordable and concessional climate financing to help countries cope with climate risk, quite apart from traditional sources like official development assistance and MDBs. So now to illustrate the challenge, the size of the investment challenge, the independent high-level expert group on climate finance that's chaired by Nick Stern and Vera Songwei, of which I'm also a member, gave some estimates of investment needs to meet the climate goals globally and of countries. So they estimated that the incremental climate and nature-related annual spending, at least based on the report last year, will be 1.9 billion by 2030, of which 1 billion will be from domestic sources, but 900 will be from external financing. Now, the aspirational expectation of this estimate is that half of the external financing will come from private sources, and the other half, at least 450 billion, will come from MDBs, official and concessional financing. So that's the broad range of the financing challenge for developing countries, well, except China. Now, for each of these categories of financing, the gaps are quite large. Other speakers have mentioned the scarce private resources that have come to support the climate agenda. But one of the scarcest actually is concessional financing. Now, which unfortunately, this is needed for adaptation and building resilience, dealing with loss and damage, ensuring a just transition, and investing to restore natural capital. many of these investments don't come with revenue streams that attract private sector. So the quality of financing is quite important for certain types of investments. And these are all currently severely underfunded. And estimates from the UN about the underfunding of investments that would be needed to address climate risks. Now, the impact is quite severe. There's a lot of documentation of the impact of disaster risks on growth prospects, on the debt trends of countries, and of course lives. Now, at this point, what lies ahead for MDB and concession climate financing? What's actually going on, and what are the prospects? For MDB financing, there's a lot of work going on. Kevin and others involved with the G20 have been very active in finding the means, suggesting means to expand the lending capacities of multilateral development banks, including the World Bank and other regional development banks. They call it stretching their balance sheets. Now, that helps clearly, but that may not be enough to actually scale up to the levels required. So at some point, additional capital will be needed from member countries, and of course, that would be politically difficult. Now, the other source is the supply of climate concessional financing that actually relies still heavily on ODA, which at this time is under great stress. So by all estimates, I guess 9% fall in ODA in 2024, and is projected to fall even further by an additional 9 to 17% in 2025. So if one looks out to the future, it's quite hard to conceive of ambitious growth in concessional climate financing with this kind of stress. And that comes from national choices of the major donors who are themselves confronting alternative uses or alternative needs. So what might be potential alternative sources? And these ideas are not new, they are on the table, but it will require quite a bit of work to get to yes, at least among coalitions of countries. What are the options out there that have been put on the table? Well, the first one is special drawing rights. Antonio mentioned it. There's strong advocacy for new issuance of SDRs. That will require supermajority of the IMF, so that will be quite difficult. But you have a large pool of SDRs that are unused by countries that are not expecting balance of payments problems in the near term. So, and they have used that, they actually have in 2020, after the 2021 SDR allocation of $650 billion billion of SDRs, developed countries agreed to rechannel SDRs for on-lending through the IMF. Then that was done, actually completed, and more than 100 billion were rechanneled. Now there's an ongoing proposal to ask countries to use their SDRs to contribute to the hybrid capital that MDBs might issue. But there's been such a great reluctance among central banks to buy this hybrid capital, primarily because of concerns about the preserving the reserve asset quality of SDRs. So that idea did not materialize, or has not yet materialized. Now, but there is clearly scope, given the large amount of SDRs that could be potentially used for other purposes, and it would be useful to see how it could be rechanneled through MDBs. And I'd say more work is needed to understand where the reluctance is really coming from. Now, there are alternative proposals, and one is done by Brad Setzer and Paduano, where they propose that countries themselves can simply voluntarily buy the hybrid capital of MDBs. They don't have to rechannel, it's their investment choice. But that has not yet come to pass. So what's another option is what they call global solidarity levies. Now, this 3 years ago, we were quite reluctant put it on the table. But since then, there's been a lot of interest and a lot of discussions, in fact, on it. Very difficult. But what are they? These are new forms of coordinated taxation on high-emitting activities or selected cross-border activities to generate funds for national action, but also for climate action elsewhere. So the sharing of revenues. So these are national levies, most of them are, but part of the revenues will be shared for climate action, is that's the idea, based on some principles on solidarity and shared responsibility. Now, each of these levies can actually generate large amounts of revenues, at least based on, prospects. Now, there is a positive development in that the IMO, the International Maritime Organization, industry-led decision to put in place emissions targets and a carbon emission pricing of sorts. And the decision actually refers to supporting developing countries vulnerable to climate change. It's not quite, there's no detail on it, but there is a reference to it. Now, even at this initial stage, the expected annual revenue actually could amount to 10 to 12 billion dollars annually. So, and part of it, of course, will be used to green the shipping industry, but hopefully part of that could be shared for climate action elsewhere. Now, the second development is in Sevilla, where 9 countries committed to put in place levies on premium aviation tickets and private jet fuel. And again, with explicit reference to sharing part of the revenues to support developing countries. Whether this will be enough to demonstrate and to catalyze further action, we don't know. But at least this is a good start. So now there are other solidarity levies beyond taxing high-emitting activities or sectors. They have financial transactions tax or financial sector levies, which have been on the table for a long time. And some countries have actually done it. But this time, the hope is it would be much more, it would be adopted by many more countries. And of course, the global taxation of the super rich, which could be taken up with the UN tax convention, hopefully. And then, of course, more effort to make international tax cooperation work for developing countries. So these are, most are domestic taxation decisions, as I said. So there needs to be some, one other hurdle is to have a shared understanding on how to share these revenues for climate action and poverty reduction efforts elsewhere, which will be very difficult to do. So, and most of these can be pursued by a coalition of countries, I understand, with all the technical work that have been going on. Although some, I can imagine, will require global consensus, like taxation of the super rich. So, or coordinated taxation of the super rich. Now, there is ongoing work, fairly active consultations by the Global Solidarity Task Force, or the Global Solidarity Levy Task Force, to give some technical work to inform the discussion and conduct consultations on the reception from the public to the levies, and also some principles for revenue sharing. It's a long way to go, but at least it's openly done and it's being discussed. The third one, and this is the last one, is carbon pricing with global requiring global coordination. Now, you're aware of the EU cross-border adjustment mechanism that will be in place by 2026 or 2027, is highlighting the need for such coordination. I mean, carbon pricing is a national choice and a national policy, and countries have been quite hesitant to actually put up the level of the price or impose explicit carbon pricing, particularly developing countries. Now, one of the emerging issues is how do you ascertain carbon price paid in the exporting country that also use non-pricing carbon instruments? That's one question. Now, the other is, what should be the expected price of the exporting country when they actually have very different levels of development? That's the next question. And the third is, well, how do you use the revenues from the CBAM? Because if you use it in the country, in the EU alone, it actually will exacerbate the gap between countries. So the competitiveness gap among countries. And so should it be shared with developing countries to help them green their economies? So, so those are the three questions that are ongoing in the discussions, in the consultations, as the CBAM approaches. And of course, finally, there are innovative instruments that are being discussed. How to say it, exemptions in the debt clauses in terms of climate risk, or even insurance with subsidized premia. But the question here is, how do you put them to scale, all this innovation? So I guess, given this, I mean, these options are not going to happen overnight, if it happens at all. These are still aspirational ideas, which are being discussed in various forums, with countries getting increasingly involved. But there's need to stimulate policy discussions, and think tanks have a role, and people with voices such as Joe will have a role. And I hope that I see think tanks more actively involved on trying to see whether we could reshape the global concessional financing landscape. Thank you.
Thank you, Marion. I don't know what the rules are. We started a little bit late. I don't know if we can go beyond the 10:30. I feel we should really open it up, because we've raised a lot of questions. This was the polite part of the panel. I was at the BRICS meeting in Brasilia a couple of months ago, and Paulo Batista, who was Brazil's representative to the IMF during the global financial crisis and the architect of the new development bank, basically raised the question, it's okay to talk about reform, but it's not going to have the politics of the day essentially mean that the multilaterals, in his words, are unreformable. And then if they are unreformable, and we've spent our lifetimes trying to reform them in one way or another, what do we do given the challenges that Jose Antonio and Shari and Mary Lou have outlined? What can developing countries do differently within different spaces to be able to mobilize resources on the scale that they need, to be able to protect themselves against external shocks of one kind? I mean, what is the politics now that we have to come to terms with to actually deliver for developing countries on their needs? I feel that, I'm sure you all have answers to Bautista's proposition, but maybe we should open it up to the floor now, because there's a lot of people in the room who have thought about these questions. So if that's okay, is that okay with the panel? Okay. I'll take three at a time, I think. Jayati, Barry, and Isabel.
Hi, thanks, and predictably excellent panel. I wanted to actually pick up on what Richard asked in terms of what we can do. And I do remember in Seville, there was a lot of discussion about the platforms for action, which are plurilateral or, So first I wanted to ask, has anything come of those really, except for those declarations? There were so many different SPAs that were announced. So has anything sort of happened with these platforms for action? Other than that, are there other regional and other initiatives that are worth pursuing systematically? I'm thinking PT-LAC that Jose Antonio had to start in the progressive taxation group in Latin America and the Caribbean, or the African Union's attempt to form its own credit rating agency, or the FLAR that Jose Antonio mentioned, and so on. Particularly also, I think, Shari, you talked about regulatory changes, which was a big discussion, right? But again, always multilateral. Is there any scope for combined regulatory changes in regional or other groupings?
Okay. So I think the panel seems to be on another planet. I mean, maybe I'm more wrong, but the message I took from Sevilla was, and of things that have, sort of happened internationally, was to developing countries, you're on your own. And not only that, the world cannot count on global cooperation for public health, for dealing with pandemics, that, you know, global warming is here, and, you know, the efforts for mitigation are out the window, that not only did the U.S., you know, eliminate its aid programs, but the European Union's view on aid seems to be, through its gateway, seems to be promoting European business, right, in developing countries. So, I mean, it's not a new idea, but so tell me, oh, wait, no, of course. And the Europeans have to get ready to go to war. It seems the Russians are, you know, seeing whether that's an option. Is any of this happening? Is the UN just going to be a smaller, you know, an organization with a smaller budget, or will it have to do different things? That is to say, stop doing many things. Sherry's academic input into the discussions. Yeah, but you don't mean all academics. You certainly don't mean Project 2025, you know, kind of thinking about tear the whole thing down. So where are we?
Yes, I would like to think the topic that we must really revisit, the issue of the private sector. And with regards to social sectors, at least, we should, you know, there were many voices talking about ring fencing social sectors from, you know, from regular private sector and activities. And there is so much evidence of the negative impacts in terms of quality of services and goods and services, in terms of prices, in terms of lack of investment of private sector with time. We have so many evidence of countries that have renationalized, you know, or remunicipalized public services, from water supply. The most known case is Paris, which actually in 2010, and the price of water went down immediately by 10%, and the quality improved. And in Africa, we have these massive investments in private hospitals that actually are being seen as a really bad practice. In Lesotho, there is a PPP of a private hospital that actually cost more to the government and the whole health budget of the country, you know, and all because of an investment on a private hospital that is mostly serving the elite of the country. So, you know, for all these reasons, you know, really, it cannot be happily say that the private sector will take over. And additionally to all that, and we have worked with Joe on that, the fiscal costs are actually so high. In pensions, for instance, the privatization of pensions have taken some countries to spend up to 20% of their budget just on the privatization. You know, so a reason why the majority of countries that privatize pensions actually have reversed the privatization and have turned back to national systems. So for all these reasons, you know, that the voices that were claiming at least to ring fence social sectors from, they were not heard. And it's something that we must continue to put pressure to bring the evidence and make the case. Thank you.
Thanks, Isabel. Good questions. Gloves are off. Do you want to start? I'll just go back down. Start with them there.
Well, very interesting question. I will start by telling Barry that I don't think the compromiso de Sevilla is what you said. I mean, it's more what I said yesterday. It's multilateralism without the United States. I really, which is a challenge, but I really, I mean, the European Union, of course, in terms of ODA, is now reducing funds, but I think the European Union is very much in the line of an alliance with the developing world, and probably with the products with the United States they might emphasize that element a bit more. But anyway, so I think there are opportunities, and we will have to see them, how they are reflected, for example, in the meeting of the Bretton Woods institution now in the next month, to see if there is and of course the financing for development meetings here in the United Nations, to see if what actions, as well as the other things that were agreed in Sevilla, for example, on debt, how those processes take place. So now, I think, in the question of what can be done, following also Giovanni, I think for me, regional institutions are very important. Strengthening regional institutions, including development banks. For example, in Latin America, the most important development bank is actually now CAF, the Development Bank of Latin America, which is the All-Andean Development Bank. Zero money from the United States. The only two countries that are non-Latin American that are partners, which are Spain and Portugal, for historical reasons. Let's say, at least the largest is more important than the Inter-American Development Bank now. So there are lots of possibilities of doing regional financing and actually national financing. For example, one topic that I find very important, including from my own practice at the national level, is the development of domestic bond markets, aside from national development banks. And I think there are many possibilities of working and supporting the development of domestic bond markets, so that countries are more self-reliant in their financing. That's another. Now, additional on private, I think it's a good question, but I think there are many interesting possibilities of having private financing, even in the social sector. In the social sector, but in the case of the environment, I think there are many private firms that can be financed that are willing to support the issue of climate, for example, and which is of course some mechanism of support, even from national development banks, or a partnership between multilateral and national development banks. Can be very important in that area. Even more in the case of climate, even more than a state firm, which of course can also play a role in that regard. So there are many interesting possibilities, and I don't mind private hospitals either. I think they can play in my country. They are the most important, so it's and of course the private insurance, health insurance system. I mean, they can be a complement between the state and the private sector in those areas. By the way, in the case of climate or environment, I say I would emphasize biodiversity also and desertification as two really important issues. I don't know why the health climate takes all the time the agenda. Biodiversity is even more important because we have done worse. The world has done the worst in destroying biodiversity than in damaging the climate, which is also very bad. But and one of the issues which is very important is deforestation in the development countries. So how in Africa and Latin America, for example, in South America, it's the Amazon is a major international issue. So how do we protect forests is a really important priority. Again, there might be actually interesting private-public partnership that can be thought.
So on the first on Barry, your question, I think that you're describing the really complicated global environment, and that's true. That doesn't, I think that Sevilla, I see it as differently. I see it as coming together despite that and being able to come up with an agreement where most of the world came together to say we are going to continue to work together on these problems despite how challenging and how big the challenges are. So I think there's another way to look at this, which gets to Jayati's point on the SPA, that there was a real push for coalitions of countries and others to come together to show that they are with Sevilla Platform for Action to what they're going to do to start implementing this agenda on their own, together in coalitions. And so we are in the process of working with Spain to follow up on those. They will be reported on at the FFD. There will be opportunities to report at the FFD forum in April. We will be reporting on them in the Financing for Sustainable Development report. We're putting together a database. So the idea is to make sure they don't just land, but to make sure that they are continue to be brought forward. And we've actually gotten several countries coming to us afterwards saying, we'd like to give you a SPA now. So there's actually, it may be something that continues to live as there are new opportunities for countries to come together to have agreements and make announcements and to put the agenda forward. One of the original things, I think there's a hook, when Jose Antonio, when you were talking about the IMF intervening in markets, and then the next, we know that in the current configuration will be unlikely to happen. But then there is this question, as you said, of having regional entities to do that. And I think there is actually language that survived on that in the outcome. It's just the hook. It's not going to happen on its own, but I think that it was discussed, and there's, I think, a hook there to say that this is something that should happen. And so that could be something to follow up on to see are there ways to move that forward and make that happen. The getting to private, Isabel. So no, I agree with everything you said. I think the only difference I would say is that I think that that focus on social is that there's maybe I keep looking at things optimistically, but I think that there is a much better understanding of the need for public finance than there was, let's say, 10 years ago, and certainly than 20 years ago. Like, I think that there is an increased understanding that social services in general, for equity reasons, if not, have to be that the cost of doing it, if you give it to the private sector, is just will make it unequitable. Like, it's one of the things that makes me crazy when I hear about everyone talking about bankable projects and saying the public sector development bank shouldn't compete with the private sector. And it's like, well, of course, anything can be structured to make it profitable, but where the money's coming from and whether it's going to have enormous equity implications to it for the cost of accessing these public services makes it meaningless to say that these are, why are we turning these into bankable projects? But I think but I actually see a bigger shift to that understanding of that much better. I mean, when you talk about private hospitals, I think the big issue there was that, as Isabel said, that in some of these examples, the whole public budget went to finance these private hospitals, and it ate away, that example she gave, ate away the entire public health budget. And so these questions of how do you do this right is, I think, where we have to go. And so where does it make sense to have private, and where does it not make sense to have private, and we need to have public, and when does it make sense to bring them together, and in what considerations? And I think those questions are still completely unanswered. And so I'm hoping that part of the follow-up process is to try to rely on all of you to bring ideas to this process so that we can not end up 10 years from now in a similar situation saying, well, that went nowhere, and it was a really bad idea. So if there are ways to think about how does one make this work in a way that's actually meaningful is hopefully the goal of the follow-up process that we're trying very hard to put together with no resources.
Just a bit of addition on Barry's comment about, well, climate is out the window, climate mitigation is out the window, and that you're on your own is a sense that countries are getting. For you're on your own, yes, there's an awareness that they really have to step up in mobilizing domestic resources, and there's scope to do that, enhancing the revenues, being more efficient in their public investments. But clearly that will not be enough. And if one takes a look at surveys of finance ministers, for example, ministries, it's quite clear that there's a lot more awareness of ways to green the economy, or the need to green the economy, the need to do more adaptation, the need to recoup biodiversity losses. There is, how do you say, it's sort of not quite mainstream, but it's coming into the awareness of policymakers. Now the issue is what will come next? Will they keep up this effort? And so it's really important to keep up the advocacies for this and not to, not to completely go with the flow of the sense that climate mitigation is out of the window, for example. And that's, it's okay to live in another planet. So thank you.
Questions. We haven't brought in the dollar yet and the nature of the dollar system, which is pretty critical. Nor have we talked about the lack of ambition. I mean, I was amazed at the recent meeting in Shanghai of the Shanghai Cooperation Organization. She just came down and said, we need a bank for this group of countries. When was the last time a Western government made that kind of initiative? I don't hear it, and that issue of ambition seems to be missing from a lot of the leaders of the current multilateral space. But, sorry, I digress. Question here. Here, and Mary.
Mary van Rodriguez, so I'm again trying to bring the voice of the European Union and progressives. Many thanks for the panel. I agree with your assessment of CDE. And let me refer that the European Union right now is preparing a quite relevant instrument called the Global Gateway, which will involve around 300 billion a year for public-private partnerships. And from our viewpoint as progressives is to reframe the way such an instrument will be used in the future on the basis of strategic partnerships which should give a voice to the other partner. A good example is the upcoming summit, African Union, European Union. We'd like to start by hearing to the needs expressed by our African partners. Now, I have a question. It's a bit out of the box, but I'd like to connect this discussion with another important outcome of Joe Stiglitz and all the team, the so-called beyond GDP. And my precise question is the following. If we move in this direction of measuring value beyond GDP, what would be the implications to measure debt and the ratio, the so-called ratio, debt-GDP ratio? Because I think this would have implications. Example, if we think about countries who are low carbon, in fact, they are providing a service. They are providing a climate service because they are low carbon. Even the industrialized go to a low carbon industrialization, they are providing a service. Can this service be paid? Can this service be given a value? Another example, because we have in the title Transition Towards a Green and Digital Economy, if we start really measuring the way value is produced in the digital activity, starting with the provision of big data, in many cases it's provided for free, but could be paid, then we can find out other solutions. I'm just suggesting that we reach a point of difficulty where we really need to be bold and to think out the box. So, but of course, I'm just provoking you.
Thank you. So, a topic that I'm greatly interested in, and fundamentally we are looking at global public good financing problem without a global government and with weak ability for global regulation. I'm interested to know what kind of innovative financing instruments are emerging, or what you think are the most innovative ones that are emerging to try and solve the problem. I have a sort of particular interest because in Sri Lanka, we did innovate recently. We launched the first G bond, the ESG, the governance-linked bond, which made the case to the creditor on their own interests. So we didn't, in other words, look to the benevolence of the bank, the broker, or the bond trader, but even with regard to their own self-interest, we made the case that G bond was a good investment, and they actually took it, and Sri Lanka launched it in December. I do feel there is room for innovation in climate funding, but I may know too little about it, so I was really interested in what the panel is knowing and seeing in terms of innovative instruments trying to solve a fairly well-understood economic problem. Thank you.
Thank you. I will push Giovanni a little bit. So you mentioned the importance of regional arrangements and South-South collaboration. So, but I feel like many times developing countries are swimming against the currents because if you're seeing, you just mentioned the importance of local currency bonds. That's agreed, it's very important. And then you have that distress, and then the IMF says, oh, by the way, we're starting restructuring by your domestic currency debt, by your domestic debt. So you put all this work that takes time in jeopardy. Or we have the question of the hierarchy of the MDBs. So World Bank clearly has a preferred credit status, but when it's a South-South, the TDB, the African Exim Bank, then they are a multilateral South-South, but then now they need to be debt relief. I'm not saying they don't have problems. We know they lend very expensively, but or the NDBs in the IIB, their preferred credit status is actually not recognized by the credit agencies because there was no default, so we never know if they're going to be preferred or not. So everything that developing countries do is actually much more difficult to do. So how do you strengthen them, and what should be the position of developing countries to, actually protect their institutions?
So, and it's been a very rich discussion. I just want to raise a few points. And beginning from the theoretical observation that our Jubilee report focused a lot on, which is financial markets don't operate like neoliberal markets are supposed to. They're real market failures, and the international architecture, including the IMF, really hasn't fully recognized it, though they were created because Keynes and Bretton Woods recognized that there were these market failures. So one of them is, a couple of them have already been mentioned. One of them is that capital flows are pro-cyclical for developing countries. And rich countries should be able to bear the risk, and it goes just in the opposite way. Secondly, if you look at a portfolio of sovereign debts from developing countries, a diversified portfolio, the market is supposed to be able to spread that risk, and there should be no risk premium. But historically, there was a very large risk premium. So, in some ways, if you were looking at this in an abstract way, you say the first order of business is to try to figure out what is the cause of the market failure and what we can do to address, alleviate that market failure. And that might include better contracts, and what are the barriers to those better contracts. But the second thing are public institutions. There are externalities, and then assessing to what extent are our existing public institutions, global, national, and regional, addressing those. I want to switch now to I think important challenge. If you think that to a large extent the international institutions that have been created to address these problems are created in part as a result of distribution of power, and therefore they're going to be used by the powerful countries to advance not the interest of their people, but the interest of Goldman Sachs, BlackRock, or the big power players within those countries. When asked to sort of have some sympathy with the view that these multilateral institutions are going to be very difficult to reform. And also, given the degree of selfishness, you can't expect a lot of help from the advanced countries to developing countries. There's some, because there is some self-interest, particularly on climate change. And there may be some self-interest because it used to be viewed maybe that there was a competition for the hearts and minds of those in the third world. Trump doesn't seem to recognize that, but you could imagine a world in which that kind of competition reemerged as a motive of advanced countries helping emerging and developing countries. But if you take those two propositions together, where does that leave you? I think it leaves you to what Jose Antonio talked about, importance of more regional institutions that are less reliant on the advanced countries. It leads you to thinking about, particularly right now, institutions that are what I call G-1, and I'll comment on that. And it makes you go to new development, new institutions, like the New Development Bank. And I was involved a little bit in the creation of the New Development Bank, and we focused on new mandates, new governance, new instruments. And we could talk about it that way because we weren't tied, the hands weren't tied. There were a lot of complexities. India and China all didn't have the same agenda, but you were still able, within that framework, to get a political institution that was committed to the creation of a possibility of making more lending to Africa and to other developing countries for climate change. Once you think about it from that point of view, you start thinking about, let me just give you a couple things. Some of the things that have been brought up are really important. The SDRs, an expansion of SDRs, a significant expansion like Bruce talked about yesterday of 300 to 450 billion a year goes a long way in meeting the finance gap that you talked about. But right now, the United States is in a position of vetoing. But there's no reason why the rest of the world can't get together. It's a global reserve currency. A global reserve currency without the United States is not as good as a global reserve currency with the United States, but it's better than no global reserve currency. So the question, and the discussions of regional reserve currencies. So the question is, can the rest of the world get together and decide to issue their own global reserve currency, like an SDR, that could be used for climate? And the final comment I want to make very, very briefly is on the issue of public-private partnerships. I think the point that was made earlier that there's a role for new development banks, a role of national development banks, new development banks, multilateral, I think is well taken. And one of the functions they have is constructing projects that reflect public good. And if there are well-chosen, well-designed, internalized externalities and so forth, there's no reason why there can't be private finance on these public platforms, if you want to think of it that way. On the other hand, I think traditional blended finance and traditional public-private partnerships have been mostly a failure. Already, the reason for that has already been made clear. Somebody said the private sector is basically interested in profits. And why would you think that if you just let it to them, they would try to take advantage to the extent they can of the public sector. And so they want the upside, they want the government to take the downside, and they take the upside. Perfect risk sharing. And that's happened over and over again. So, and I think we can combat against that. But if you ask the question, what is blended finance done? Is it the most effective way of stimulating private contributions to climate change? If you begin with the premise of the Modigliani-Miller theorem, you say this is, not necessarily a good use of public money. And I think I've not been convinced that the whole architecture of blended finance actually has been very useful in that there would have been better ways of leveraging the scarce public money and scarce risk-taking without the private sector appropriating excessive returns from it, which is, after all, what they're trying to do. And so finally, let me say, I do think there's real scope for new private instruments. The private sector isn't always as innovative as it could be, and that one of the discussions that we had on the Jubilee Commission was what kinds of new contracts might better resolve some of the failures. But the collective action clauses that were put in 2015, 18, something like that, did not solve that. So not all the innovations, they may move you in the right direction, but may not be enough really to resolve the underlying problems that we talk about as fundamental flaws in the global financial architecture.
I'm going to have to leave the last word to Joe on this panel and leave some of these questions pending for coffee time, because we've already infringed on our coffee time. So let me thank the panel for their contributions, and a round of applause, please, for this session. Thank you.
So in order to stay halfway on time, I think we should get panel number 6 flowing. So welcome back, everyone. By ways of brief introduction, my name is Chris Moser. I'm an associate professor here at Columbia Business School. Been here for 9 years, and working closely in various capacities with Joe, Martin, the IPD, and all its wonderful activities. I was asked, and I feel honored to be chairing this little panel. A lot of my work is on labor markets, more recently also on inflation. A little bit on issues related to international macro, but that's the one I'm going to be shaky on and relying on my wonderful speakers, panelists today. Let me introduce the people you're really here for. So we have 3 panelists that will share with us their views. The first one will be Giovanni Dosi, who's the professor of economics and the director of the Institute of Economics at the Scuola, Superiore, Sant'Anna, and Pisa. He's also the co-director of the Intellectual Property Rights Task Force here at IPD. He's a member of the Accademia Nazionale dei Lincei. I had to Google and YouTube how to pronounce that. I'm probably butchering it, but it's an esteemed national institution. He's also the author of a large number of works in the area of, among others, the economics of innovation and technological change. He has published numerous research articles, volumes, and most recently his book on the foundation of complex evolving systems, which was published early in 2023. We're going to follow that up with Brad Setzer. He's a senior fellow at the Council of Foreign Relations of CEPR. Brad received his PhD from Oxford University. He's an expert in a range of topic areas spanning global trade, capital flows, financial vulnerability, and sovereign debt restructuring. He's a regular blogger. You may have already been, on his followers list. If you're not, I encourage you. It's a delight to read. He served as the senior advisor to the United States Trade Representative from 21 to 22. Before that, he served for some time as the Deputy Assistant Secretary for International Economic Analysis in the U.S. Treasury, and he's authored several articles and reports, including one on sovereign wealth and sovereign power. Third, we're going to have Mark Weisbrot, who's the co-director of the Center for Economic and Policy Research. And Mark has authored, an illustrious number of writings, including a book called Failed: What the Experts Got Wrong About the Global Economy. He's also the co-author, together with Dean Baker, of Social Security: The Phony Crisis. He received his PhD in economics from the University of Michigan, and his opinion pieces have appeared in popular outlets such as the New York Times, Washington Post, and just about any major US news outlet. Also some famous international ones, like the Folha in Brazil. He appears regularly on national and local television radio programs, and we're delighted to have him here along with our other panelists. So I'm going to open the floor. Giovanni, we're going to have a 15 minutes dedicated time for each of our three panelists. We'll start with Giovanni, before we then turn to a moderated Q&A and an open floor Q&A. The floor is yours.
Well, I'd like to start recalling briefly some of the features of now remember the three glorious decades after World War II. Bruce already mentioned it. I mean, what made the socio-economic fabric work at the time? I mean, for our purposes here, let me call 4 factors. One, you had fast technical change associated with high productivity growth, with the production, automation, product innovation in consumer durables. These consumer durables were bought by an increasing share of the population in Western economies because of an income distribution that essentially was indexing the wages to productivity. So you had this virtuous circle that in turn was based on a sort of social compromise among social classes. Call it in Europe is social democrat compromise. Here you could call it New Deal. And this is cut across the parties. You had a fundamental commitment by everyone to full employment and to indexation. Finally, on the generation of new knowledge, the generation of science was run like a scientific common, to use Paul David words. That is, the public was nurturing the endless frontier, as the book by Vannevar Bush, nothing to do with the Bushes later on, in 1945. All this broke down for several reasons that, and we don't have time to discuss here. But let me just mention a few. One, you had an increasing financialization of all economies. Globalization was, first of all, a financial globalization before being a production globalization. Within that differentialization, you had an increasing share of rent. And I think for the first time, the good deal of these rents was associated with intellectual property rights. In turn, intellectual property rights expanded their domain to, in a sense, erode the scientific commons, starting with the Bayh-Dole Act all the way down to the current state of affairs, you had an increasing role as a sort of rent, especially in some socially crucial domain like pharmaceuticals. You had this expansion of the depth and width of IPR that turns out to be a major obstacle for innovation, not only in developing countries, but also in developing countries. All this came together with the rupture of the social pact that characterized implicitly or explicitly the first 3 decades after World War II. And with that, it's absolutely clear. You see a divergence, a dramatic divergence between the pattern of growth of productivity and the pattern of growth of wages. That in some countries, including the US, the lowest bracket of wages in real terms actually fell. I remember when I was here finishing high school in the States, just to get some money for my expenditure, I was getting the minimum wage that was $5 per hour. That was changed by Obama, the minimum wage. And a few months passed between when I was here in high school and now all that came with the neoliberal revolution. The neoliberal revolution is much more than, as I was trying to say yesterday, is much more than economic ideology. It's a Weltanschauung, it's a vision of the world. And it's a sort of metastatic construction that develops to all domains of life. You read economic papers, and you have the economics of organs, trade, the economics of suicide. You've got articles saying the equilibrium level of torture. You have all these things because it's a general vision of the world. And on that, I've got some doubts that it is the end of neoliberalism. I think we are not seeing the end of neoliberalism, but on the contrary, the deepening of neoliberalism. If you allow me an oxymoron, we are getting into an authoritarian. You have, think of the administration here in Argentina, in Italy. You have the deepening of the same philosophy associated with the restriction of political freedom and individual freedom. So, let me spend the rest of this little short presentation. What should we do? One thing that should be done in general is, I think, push back the frontier of what belongs to the market and what does not belong to the market. I mean, up to the 70s, it was absolutely clear, especially in Europe, that we lived in a mixed economy. Read the old book classic by Andrew Schoenfeld, Modern Capital. And in fact, this is a fundamental domain of foreign industrial policy written large. This is what we discuss in one of the chapters on industrial policy and development, co-authored by Giovanni, among others. There are things that in a period and in many countries were rights, not object of exchange. Health, education, especially in Europe, these were universal. Everywhere, the frontier of markets expand. In Italy, we are very advanced, so we have also market for justice. We are really ahead of many other countries. Pushing back the frontiers, I think, is a meta policy that is precondition of many other actual policies. Another domain in which the frontier got to be pushed back is precisely the generation of new knowledge. Already I was saying before, after the Bayh-Dole Act, you have got an expansion of IPR, etc., also to the scientific domain, university, etc. Well, the most recent measure in this country are a disaster in that same direction. In fact, I mean, I signed in Europe a petition called Rebrain Europe, saying let's try to do in Europe what we did tragically with the United States in the 30s. In the 30s, the authoritarian government, Nazi government, fascist government, pushed intellectual away in all this country. Let's try to attract them back, given the situation of the academia and of research here. More generally, I think that it is necessary to think in each country. It would be beautiful to have it international, but it does not work. In each country, in each region, some sort of socially just green New Deal, with a feeling of urgency. And when things are urgent on the top of the agenda, then you don't leave them to the market. It is serious things cannot be left to the market. I mean, wars cannot be left to the market. In fact, you don't have 3 months after Pearl Harbor, this country was almost a centrally planned economy. Because when you've got a serious thing to do, you cannot wait for the market to do that. I think we need to tackle the climate emergency and the forthcoming medical emergency with the same seriousness and urgency. Behind all that, I think that it is necessary to rediscover social conflict. Getting out of neoliberalism means also recognizing that social groups have different interests. As Joe was saying a minute ago, you cannot hope or convince Goldman Sachs or BlackRock to be equivalent to the Catholic Church Caritas. I mean, it's important. You've got to rediscover power relation within and across social group and across countries. In order to do all that, you need to rediscover taxation and the progressiveness of taxation. It is possible. Joe has worked on that. We have also technically the mean even to curb very mobile capital flows. It is a matter of political will, much more than a technical matter on how you tax footloose capital. The big issue is that, and I finish my question mark, who's going to do it? I mean, who are the social actors that will push in this direction? Trade unions are extremely weak. Social democratic or equivalent, the center-left party have basically betrayed or dissolved. And this is a big challenge to reconstruct a social coalition to do this thing. And on this,
Lots of interesting thoughts. I'm going to keep in mind the authoritarian neoliberalism. I like that one. So with that, let's pass it on. We have Brad next. Brad, you have 15 minutes to share your thoughts.
I'm actually open to the idea of relocating to Europe. There may be some opportunities there. Just a hint. I wanted to pick up on some of the themes that Professor Stiglitz raised in his comments, or questions disguised as about the post-cyclicality of global capital flows, some of the institutional innovations that I think are within the realm of ambitious, yet not so ambitious to be impossible, and then conclude at the suggestion of the moderator or the organizers with a couple of words on Stephen Myron's paper, discussing both what I think it is and what I think it actually is not. So I think we now have ample evidence that global capital flows to lower income countries are almost intrinsically pro-cyclical. I've kind of lost confidence that there's some magic sets of reforms that will change the nature of global capital markets so that they will be more risk absorbing than risk creating. Why? Because I think in general, capital flows to low-income countries are much more a function of conditions in the creditor country economies than in the recipient economies. When global interest rates were in the low for long period after the global financial crisis, it took a little while, but eventually there was a classic search for yield. And when there's a classic search for yield, investors get tired of making 3% in U.S. Treasury bond markets and suddenly get interested in lending to low-income countries at 8 or 9%. And they convince themselves that this is tenor. But when market conditions turn, that market opening ends. The marginal borrower was always squeezed out, and the capital markets to basically demand their money back. You're renting the money for a short period of time. And I actually think Chinese policy bank flows tended to augment, at least in the past cycle, this pro-cyclicality rather than counteract it. There's a very high correlation, actually, between the peak of bond market flows to what are called the frontier economies and the peak of CDB and China XM lending. Both kind of surged over the period from 2011, 2012 to 2017, 2018. And then both actually turned and contracted after the pandemic. The bond market seems to want to lend not to countries that want to invest in renewable projects or that need to build out basic infrastructure. The bond market wants to lend to a country like Saudi Arabia. Saudi Arabia has more reserves than it has international bonds. You're going to get repaid. Saudi Arabia has an enormously valuable oil company, which they've started to privatize. So you have a second source of repayment. And then Saudi Arabia has a sovereign wealth fund that they want to grow. So all of a sudden, the biggest borrower in the emerging world is Saudi Arabia. It is on a trajectory where it will be the biggest component of the index. That is a role for the market, but that is not a role that really solves the core problem of financing development. And I think, unfortunately, a lot of the Chinese lending also tended, not exclusively, but tended to also flow in somewhat similar directions. The biggest borrower in Africa from China is Angola. And China was interested in Angola because Angola has a lot of oil and China needs oil. So I've sort of come to the view, unfortunately, that you can't really rely on cross-border capital flows to solve most the development challenges in low-income countries. So that leads me to think about ways in which we can have a more sustainable pattern of flows to support development in low-income countries. And it leads me to, I think, to a very similar place where Professor Stiglitz ended up, which is, we actually kind of already have most of the solution. The multilateral development banks are actually pretty good at lending, and they don't have to lend in a pro-cyclical manner. They're policy institutions. So it doesn't seem to me like there's an intrinsic need, at least for the frontier economies, which are actually quite small, where you could replicate the level of flows that was observed in 2015 or 2016 out of the MDBs with a bit of vision. I think we just need, kind of political will, commitment, the willingness to do it. So there's one statistic that I kind of like, which actually, frankly, completely shocked me, which is that for the non-concessional arm of the world, IBR, and the concessional arm is an entirely different funding model that is very capital intensive. But for the, IBRD, classic World Bank, the paid-in capital from the shareholders is roughly $25 billion over 70 years. The U.S. share of that is $5 billion. That is nothing. It would not be difficult to generate, in a financial sense, another $25 billion of paid-in capital. And then you can, over 10 years, using conservative, not made up, no blended finance, really normal numbers, you can lend $250 billion, which is roughly what the IBRD has already lent. If you were more ambitious, you could do more. For $50 billion, which is roughly the paid-in capital of the IBRD, you could basically replicate the Chinese lending boom of the previous decade. These are imminently doable things. They don't require enormous financial commitments. They just require a willingness to basically say, we're going to use the MDBs to provide a sustainable flow of capital to a set of low-income economies. So I juice it up, gas it up, which probably means it would destroy the political chances of ever adopting it. But I think rethinking a little bit the funding model of the multilateral banks. The world has $12 trillion in foreign exchange reserves. Most of those foreign exchange reserves are invested in bonds. The World Bank and the MDBs issue bonds. A little less than half of those bonds are already bought by reserve managers. The total funding needs of the multilateral development banks right now are a little less than $1 trillion, well within the capacity of global reserves. And, actually, a reserve asset, the World Bank, of AAA, they're actually better than what you get almost anywhere now U.S., not really AAA. France, definitely not AAA. They're just, they're actually higher credit quality than your main reserve assets. And then on top of that, we've got a bunch of already issued SDRs that are just kind of sitting around. And those, I can go into all the legal and technical questions. It is very hard to take a reserve asset in Europe, and Europe's the non-G1, and also in the US, and use that for equity. So just a whole set of legal impediments, policy impediments. So I don't think that's going to work. Capital, of course, is more valuable. It is, by contrast, relatively easy, not easy, to invest those SDRs in another bond, an SDR-linked bond, which the MDBs could issue, which the World Bank could issue. And I actually think that using the SDRs to provide a stable long-term source of funding, rather than just having them sitting around trapped on the IMS balance sheet where they are essentially never used, is the most efficient available use of those that trap stock. Right now, it is really hard for governments anywhere, to issue 30-year bonds. That market is kind of collapsing right now. If you look at spreads around the world, France, Japan, the UK are actually having trouble placing 30-year bonds. And you need 30-year bonds if you want to do really long-term investments. Trapped SDRs can be put into a floating rate instrument at no cost to the reserve managers and locked up for 30 years and be tradable and actually more liquid than your current funds at the IMF. So that's like one idea. The other moderate incremental idea is that, the bond market actually doesn't rethink the terms of an average bond. There's a template, standard contractual template. Actually pretty standard maturities. Most bonds are issued at either a 5 or 10-year tenor. It should be possible, and it is not beyond the capacity of the market to price, to put in, and how you get there is a complicated question, clauses that essentially give automatically a 2-year maturity extension at a modest additional interest. Maturity extension clauses are doable. A 5-year bond extendable by 2 years is a 7-year bond callable after 5. Those kinds of bonds are priced every day in the corporate bond market. Interest capitalization clauses. These are imminently doable things. Current trends have moved in the opposite direction. Current restructurings have tended to shorten maturities and pile up repayments right at the end of IMF programs. So I think we need some kind of intervention to change this. So those are my modest ideas. Stephen Moran, mispronounced. So if you read the first 20 pages of his paper, and this is what I think it is an explanation for why tariffs are not so bad. That tariffs are, in his argument, better than increasing corporate taxes. It's an argument for a Republican audience about the virtues of tariffs compared to other forms of taxation. Now, he does concede that if the exchange market offsets the impact of the tariffs by appreciating, that you won't get the desired adjustment in the pattern of trade flows, but you still will get the revenue. You can still offset corporate tax. So that's the main point of the paper. The main point of the paper is not the Mar-a-Lago. It is an argument for why Republicans should embrace tariffs as a revenue source and why it won't have as big an expected impact. What it is not is a plan for the international financial system. The suggestions about restructuring treasuries, which got all the attention, are actually derived from certain Moser. Myron tries to distance himself ever so subtly, and they're hypotheticals. But moreover, they are not the approach that Trump has taken. Trump has not asked the Japanese to accept lower interest rates on their very substantial holdings of treasury bonds. What is important is the attitude. And the attitude was that those countries, at least those who are our allies, to the extent that we still have allies, and that's how the administration thinks, should be giving us something in return for all the good we provide to the global financial system. And so the notion was that we should be getting something in return, whether a lower interest rate or what actually happened was all these investment commitments. And I do think that that is the true significance of the Meyer paper. It is a shift towards, sort of an authoritarian liberalism, but an authoritarian extractive hedge.
Much, Brad. Your comments and also Joe's earlier remind me of the Kaminsky-Reinhardt Bay, phrase of when it rains, it pours. Lots of interesting implications. Thank you. So we're going to move on to Mark Weisbrot. The floor is yours.
It's been great with the great panels here, and we talked about some really big issues I'd love to touch on, but I got 15 minutes, and so I want to focus first on one thing that we can do that actually has happened already. And I have to tell, I don't want to bore people or be too U.S.-centric, but it so happens that even though the IMF has 190 member countries, the decisions are really made by U.S. Treasury. There are about 3 or 4 exceptions to that all happened in the last few years. And we can get this, well, I'll mention one of them. And one of them was the SDRs. The Treasury didn't want the SDR. Fought against it until the House of Representatives, which passed a bill for ordering Treasury to support a $2.8 trillion issuance at the IMF. And they got worried because, for a while we had that Republican vote in the Senate. They finally gave in and supported what the maximum that they can do without Congress. So that is really an amazing thing in the world. If you think about it, it's not only one country, it's one agency within one country. And it's not even an elected official or appointed official necessarily. And so this is, but that's also a real reason why we were able to win. Because when Kristalina Georgieva made her speech in March of 2020, she said, look, she was describing how bad the world economy was getting and said the developing countries have $2.5 trillion of financing need, which is basically what they need to avoid balance of payments or fiscal crises. And so they should, and she suggested SDRs. And so that's when we went to the House and said, and then we got that bill and they passed it for $2.8 trillion. But Mnuchin first said no, and everybody shut up. And that was the end of it. Everybody thought it was the end of it. So when I'm saying we can do this, I mean there actually is a path, because there was a path then. And, who would have thought that the Treasury could be pushed around by members of Congress. But the Congress has actual power. Okay, even the House, when you only have the House, which, by the way, most people I know think that we will have after the next election. Okay, I'm not guaranteeing anything. I'm making forecasts. But, they have threatened Treasury in the past. They've held up World Bank money into the next year and other things that Treasury really wanted in order to get what they wanted. And so that is what we're dealing with. I'm sorry that that's what we have to deal with, because nobody more than me, I've been fighting the IMF for 30 years, okay? And I can tell you, I don't recognize the legitimacy of the Treasury making these decisions, but that's what we're dealing with right now. And, Joe and others have talked about, in the history of IPD, and, we try and go where there is self-interest also, and use that to get the things that are good for the world. And this is big. Okay, I want to say, we focus a fair amount on harm reduction, okay, and we try to combine that with structural change, but we also want to save people's lives, and this saved a lot of lives. We don't have an exact estimate, but or a point estimate, but it was pretty big. If you look at the Bank for International Settlement estimates of in relation to mortality and recession, for example, in developing countries, it was a lot of people, probably in the hundreds of thousands. At the time of the actual issuance in August of 2021, the World Food Organization put out a report and this was in August, it was June, the report came out, and the number of people who were facing acute hunger, which is really bad, you're really malnourished, worse than malnourished, and had increased by 81%, 120 million since the pandemic. And this the economy, by the way, the world economy was growing at 6%, so it was recovering, but this was still what the world was facing. And so people, countries use this to buy vaccines, for example. Dozens of countries used it for fiscal support as well. And here's Vera Salmo, who many of you know, has been to these meetings, and she said of the SDRs, that's the way Africa got COVID vaccines. We didn't go to the donors. We took 1 billion of the issuance, that's the SDRs, and leveraged it to 2.2, and we were able to go and stand in line and say, I have the money to buy my own COVID vaccine. And so she was head of the UN Commission on Africa at the time. So this was a really big thing, and I could go into more of how important it was. It was larger than all the development aid that developing countries got that year. And the big difference is that most of that development aid had, or a large part of it, had debt and conditions attached to it. And these have no debt and no condition. So that's a big difference. And so, we were talking, the previous panel was talking about climate finance. This is something, and it could be a lot bigger, by the way, than this, okay? And this is what other people have raised, right? Why should the majority of the 650 billion that Treasury can do without Congress, why does that go to the rich countries who can't use them? And China, also can't use them because they have 3 trillion in reserves. They have to show need. So why is that? And that's something that can also change. But even when the quota system can change, there's a lot of things, they're going to have to fight to get the quota increase. They fought 8 years for the last one because Congress held it up. And that was before you had as many crazy people as you have now. But the thing is, the Treasury can still be pressured. And I want to emphasize that too, because a lot of people here from other countries, and they can go to Congress too, okay? And we have a 100-member Progressive Caucus, and the leadership of that caucus is like us, okay, on all of these issues. And you can talk to them, and they'll move. We did it. I mean, there was also a coalition of 100 organizations, and included the International Chamber of Commerce. And that's another point I want to make, okay? Because we're talking about interest. I'm going to get to the last part of this very soon. But the Wall Street, and I've talked to someone right here in this building, okay? Anybody can tell me if as a counterexample, everybody I've talked to from Wall Street is completely in favor of this, okay? I mean, strongly in favor. I haven't heard one person say a bad word against it. And right now, by the way, there's people I know met with Besson a couple of times on this, and he's not against it either. So, and the king hasn't said no. So that's another reason why I think this is worth fighting for right now in real time, and we are. Okay, and so this can move. But in terms of Wall Street, that's a real thing. Okay, and there's people actually who have come to these meetings who talk to Jamie Dimon and others, and so that's another avenue that we really haven't pursued. I mean, I talked to people who I randomly met with Wall Street, but and they were all for it. And why don't they fight for it? You know why they're for it, by the way? It's worth billions to them. They have trillions of dollars of investment in sovereign bonds all over the developing world, and also private bonds as well. And so, when they get an extra 209 billion, that's what the EMDD, the developing countries that can use these things, that's what they got, okay, 209 billion. And when they get this, it makes a difference. First of all, it adds to their reserves, okay, and that's what it is for most countries. It's in addition to reserves. That has an impact. It lowers their borrowing costs. It makes balance of payments crises and even fiscal crises less likely.
And so their bond values are more secure and actually can increase, okay? And there's another, of course, it's also useful for fiscal support, and they can do that even indirectly, so they don't have to convert to dollars or euros or the other three currencies that they can convert them to at the fund, okay, through the fund. And they, yeah, that, I won't go into the arrangements of how that happens. If people want to know, yeah, I can go through more detail of how they work. But they still, they, without even converting them to hard currency, they can also get rid of other assets. And so this is an asset that's as good as treasuries, because it's never going to be defaulted on, okay? And that is how it's viewed by investors and the rest of the world. So, again, that's the, you know, that's the kind of the short explanation, and the harm reduction part. And you know, we do a lot of work on harm reduction. I just want to mention, just for 10 seconds, one other harm reduction that really should concern all of our work here, and that's the U.S. sanctions. You know, we talked about the whole so-called system of global governance. You know, we just did a study for the Lancet Global Health, and last month, and you can see it on the web. And I wrote about it in the papers here. And you know, that showed that for the number of people killed by the U.S. sanctions, unilateral sanctions, each year, our panel regression estimate point estimate was 560,000 a year, which is approximately equal to the number of people killed each year for the last 10 years, by the way, annually, 560,000 by all of armed conflict in the world. So this is really this is another thing that we fight for here. But I'm telling you, we're going to win on all of these things. But this one we can win. It could be at any time. Okay, this is something that is really we really should pay attention to. Now, let me go to the last thing, because in terms of their self-interest, we have another approach that we're trying to show. Oh, it's here. Great. It's going to be on the screen. It's on the screen there. Okay. I'm sorry. I was looking at that one. Okay. So, yeah. So this is, it turns out that these developing countries that got the SDR, they import about a little over $1 trillion from the United States each year, and that's actually a third of the imports that we have. Okay, and which is interesting. And so what happens when there's a downturn? Well, we lose actual jobs in the United States, and it's actually these numbers. If we look at all the export, so the BEA keeps track of export-related jobs that are lost in the U.S. So we just used their numbers and the fall in imports in developing countries for this part of it. So, some of these are in millions if you look at all the jobs, and actually some of those should be included, because when the developing world imports more from us, it has more money to spend and more economic stability. It affects, other countries as well. But this is just the straight calculation, so you can see how many jobs that were supported by these developing countries in the U.S. In these years, where they lost, that the U.S. lost these jobs according to the Bureau for Economic Analysis. Okay, and so there's a lot of room. And again, we don't have to think that this 650 billion is going to be the limit forever either. And that's something we have to change, obviously. It's completely unfair, and it's ridiculous, and it makes no sense. But in real time, right now, it's definitely worth it. There's no waste of resources with the ones that go to the rich countries that can't be used. So we should grab the low-hanging fruit here, like we were able to do in 21, and it took some work, And it took some convincing. Not everybody jumped on this like we did when Georgieva made her speech, but people came along, and there was a huge amount of pressure developed. And oh yeah, I want to mention one other thing, because Joe and I both wrote about this at the same time in 21, because this is, you know, I'm in Washington D.C. where no good deed goes unpunished, and there was an actual coup attempt to get rid of Georgieva, and this is one of the few battles that Treasury lost, and because Europe wouldn't take it, and they had a big 5-hour meeting about it at the executive board, and they lost, and on the coup, and it was a terrible thing. I mean, it was so transparent. David Malpass of the World Bank was leading. Yeah, this is a climate denier said to the press that, you know, there's no evidence that human activity has anything to do with carbon emissions. And, you know, and this is a guy, of course, you know, and she was being punished for that too, because she was trying to move the IMF in the direction. But I don't speculate too much on intentions. Okay, as you notice, I don't try to say who's doing what, why. But that was a coup attempt. There's no doubt about it, and it didn't get enough attention because nobody pays attention to any of this stuff in the media, and that's why we had to struggle so much in Congress. You know, all these Senate officers, you know, they're not paying attention, and very few people, by the way, even understand how these things work. And I'm sorry, I didn't have time to go more into that as well, because that's an important part of the story. But by the way, oh yeah, one last fact I have to add is that the World Bank is projecting 2.3% world economic growth this year, and you know that projection has gone down a few times already, and so this is kind of an insurance policy as well, and you know that 2.3 is pretty bad. When you look at the last 20 years, that's about 4 from the bottom, and that's competing with, you know, the world recession of 2009 and the pandemic recession. So, and okay, and I hope we get to talk a little more about macro, because there's things that I could say about that as well. I think it hasn't gotten quite enough attention so far, but nobody's fault. A lot of big issues to deal with. Anyway, thank you very much.
And thanks again to all 3 of our panelists. I think I want to take a bit of time to help us digest what was said before we open up the floor. It's really hard to know where to start. Giovanni, let me begin with you. You mentioned a number of interesting things related to the welfare state and the role that it plays in addressing maybe also what you called serious things. You mentioned war, but, you know, labor market issues like retraining of workers that are at risk of being permanently displaced, and an increasingly, you know, discontent voting population as a result, I think maybe is a serious threat as well. There's been a lot of work over the last decade or two on the adaptability of different, you know, occupations and different workers in the labor market. Just last week, a new NPR working paper was released by Laura Pelossa from Duke and co-authors in the Federal Reserve System. They studied the extent to which different workers in the economy are retrainable in the wake of artificial intelligence, AI adoption. And one of the key takeaways is that it works really well for some of them, and that there's no hope for a significant share of others. And so this raises the question to me again, you know, in your own words, who will do it? How do we take care of those problems that are not necessarily in the interest of, you know, financial markets, that are maybe not even on the radar right now of, you know, ruling parties? Who's going to take care of these important issues?
Serious and complicated question. The adaptability of workers to changing tasks. It's also a function of the stickiness of the labor market, in the sense that if you have got, say, at one extreme, the Toyota model, the firm is forced to retrain their workers because it's like a marriage without divorce. If you've got a very flexible labor market, then the incentives and the capability of firm to retrain is much lower. So this is another domain in which more flexibility in the labor market is worse for knowledge accumulation. And it's also worse in, there is a paper that Andrea and we co-authored that is also worse macroeconomically. I think to make the labor market more rigid, in fact, would make retraining easier. And I mean,
I love that comment. That's kind of the idea, right? I think Ashimoku and Becker before that have written about it, of the relationship between the worker and the firm determining incentives to invest. The whole that problem.
Yeah. What I'm saying is more focused on learning capabilities rather than sharing science. But that is the problem. AI. I mean, I think that we are a bit overestimating AI. Artificial intelligence is really stupid still. So with artificial intelligence, we can substitute financial analysts. But you cannot teach yet a robot how to clean a toilet.
Student RAs also, their tasks are at risk.
Because you can essentially steal with AI, independently from the energy cost that is amazing. And I mean, we talk about climate change, and then we talk about the diffusion of AI. But the use of AI has an enormous electricity cost that probably is going to defeat any attempt to curb climate change and emission. But apart from that, AI can easily do things that imply complicated repeated algorithms. Cannot substitute routines that are information rich. Cleaning a toilet is information rich material. You've got to know the location, where the dirt is, and it is very hard for a robot to do that. So I think that the AI revolution, assuming that it is a revolution, is affecting more, say, intellectual works that can be automatized rather than the lower part of the task in distribution of task.
I agree with everything you say. I think that's part of the problem, that some areas are harder hit than others. Let me invite you though on a study trip to Japan. I'm not sure if you have experienced the advanced toilet technology. In separate news, I also have a running bet with my father that by 2030 he will have a robot in his house emptying the dishwasher. I am, like you, a pessimist maybe, and my father is much more the optimist in that bet. TBC. Thanks for sharing those thoughts. Brett, if I may, you raised several interesting issues, starting with global capital flows and then moving on to SPRs. I think something I took from your comments was an emphasis on issues of credit supply and risk appetite of lenders and how they're making moves with the cycle. You gave the examples of Saudi Arabia and Angola, being very, reputed, low risk borrowers, excuse me. And so lenders, channeling, more and more funds to those countries, but not others. And I was curious to hear your thoughts on to what extent credit demand may play a role. I think the original work by what I mentioned earlier, Kaminsky, Reinhard May, the when it rains, it pours hypothesis, was partly about the use of funds as well, and that the quote unquote misuse of funds or unproductive uses of funds may further exacerbate the type of credit cycles, real effects on those emerging market economies. But I'd be curious to hear your thoughts on how you view credit supply versus credit demand, and maybe some instances of what you think are good investments in this context.
So I think it is helpful to differentiate between the well-established emerging economies, which in general now finance themselves in their own currency and actually have, in general, relatively modest demand for foreign currency borrowing. The net amount of money that Mexico borrows in a typical year from the international bond market, or that Brazil borrows in a typical year from the international bond market, is small. They clearly have demand for credit, but that credit demand is largely satisfied by their own local market. And then there's fluctuation in foreign demand for their local market paper. What makes Saudi Arabia a bit unique was that Saudi Arabia is both perceived as high quality and incredibly willing to borrow because of Mohammed bin Salman's desire to build a city in the desert while trying to match the sovereign wealth fund of his neighbors. So he neither wanted to draw down his assets nor to restrain his investments, so he's willing to borrow. I would contrast that with a lot of the very low-income countries, which I think in general are enormously constrained in their access to kind of credit of any kind. Their own domestic markets are thin. Their domestic banks don't have a lot of lending capacity. And essentially when the international capital market opens, they're willing to borrow. When China is willing to lend for policy reasons, they're willing to borrow. In some cases for good uses, and in some cases for less good uses. But to me, the lesson of the credit, I mean, Kevin Gallagher is there, and I sort of sometimes disagree with him, but sometimes agree with him, was that China showed there's actually a lot of pent-up demand in low-income countries for infrastructure. And that old-fashioned infrastructure lending has been undersupplied in a significant way. Now, it's important to do it well, but it was, to my mind, clearly somewhat undersupplied. And then I think, unfortunately, the instruments available in the bond market and actually the instruments that China used to lend weren't perfect. The bond market lends for 5 or 10 years. Not many infrastructure projects pay off over 5 to 10 years.
If I may just very briefly interject, because you mentioned the quality of investment in infrastructure in particular, I think like you would differentiate between the Brazilian football stadiums, in the Amazon versus, more long run projects that might actually pay off. I think that might be an important distinction.
I do not pretend to know, to be able to judge which projects are good or which are bad. It does seem to me that on average, Africa needs more energy. And on average, there's increases in the supply of clean energy should find it. But that's just kind of an overarching thesis. Where I was going is that what I found shocking, and China doesn't make this easy to discover, maybe Kevin will have a slightly different view, is that an awful lot of Chinese lending seems to have been 15-year loans with a 5-year grace period and a really steep amortization profile between years 5 and 15. That's slightly better than a 5-year bond, but I think it still, in general, was a payments profile that didn't really facilitate, didn't match the kinds of investments that were being done, which in general aren't going to pay off the full principal value after 15 years. Like the railway, famous railway, it may, in Kenya, it may be a good investment, but it's not going to fully be amortized and paid off after 15 years. So financing those kinds of 30-year, 40-year, 50-year payoff projects, deep infrastructure, with money which you have to repay the principal value after in year 6. Seems to me to be kind of a problem and a solve.
I'm going to throw one at Mark. Mark, you mentioned two things that I want to pick up on, time permitting. The first was about the fiscal support that goes into all kinds of let's say projects with quote unquote externalities. You briefly mentioned vaccines. I wonder about non-financial transfers. I know Joe and others here in the room have discussed transfers of intellectual property, which of course in the COVID era was a big issue. And so I'm curious to hear your thoughts, going beyond, sending financial, supports and financial seed funding. What other solutions might be on the table that might actually pay off? And if I may, as a second food for thought, and I'll let you choose between these, how to allocate your time, show these really intriguing numbers on the one slide we have here behind us for the audience. Something that this does bring to mind is the work of Otto Dorn Hansen and more recently Lisa Kahn and Brett Hirschbein, who documented meticulously the long-lasting effects of local economic shocks, be that through trade or be that through other types of economic fluctuations, on employment through technological adoption. You change your organizational structure, you adopt new technologies when there's a time to quote unquote cut the fat in the institution. And as a result of that, you might actually see some secular changes occurring, accelerated through the cycle. And so the question for you that I would have is, to what extent are these numbers that we're looking at here a purely cyclical phenomenon versus to what extent are these just times of accelerating secular changes?
Some of them are secular changes in the sense, first of all, in the 20 years we're looking at, the BEA, this is from the U.S. side of it, but they looked at the number of jobs here. They have that number, converting $1 billion of U.S. exports to jobs, and it dropped from like 6,000 to 4,100. So the composition of these exports and their, job creation changes. But looking at from the developing world point of view, I think by the way, the numbers that I used for what the developing countries did with their SDR, that was a report from the IMF in 2023 that looked at the results. And it was pretty favorable. The thing I left out also was, and this I think relevant to your question, is that countries also used it to pay off we just used the SDRs directly to pay off IMF debt. And so, but I think the biggest thing is really U.S. monetary policy. It really does affect the whole world, obviously, and people know the experience of the 80s, but I think that interest rates are, and I think remain too high of the Federal Reserve, and I mean, Powell was one of the best Fed chairs we ever had until until the inflation hit. But he really was, it turned out there's nobody who would go to the Senate and say, I'm really happy with what we're doing, because, employers are having to go to the prison to get to know the prisoners here before they get out, because that's how hard it is to find workers now. You never got a Fed chair that said that. But then, he reverted to the norm of the Fed, which is to raise interest rates when it is necessary. Now, here's where I think other people have spent more time looking at these mass movements in the world, but I think that pressure really can make a difference with the Fed. I can tell you from the experience of the 90s, it's not clear we would have had the second half of the 90s expansion business cycle expansion if the Fed hadn't changed its policy. And some of that was real pressure. There were a bunch of senators who stood up and held the Fed accountable. And, and Greenspan changed his mind on the neighborhood. And so the Fed, the stuff that Trump is doing is totally counterproductive. It's just bullying and threatening, making it look like only a monster would want the Fed to be anything less than completely independent. But it is a real problem, and it's a much bigger problem for the rest of the world. And that's where I would just say also that macro policy, that's why I think we should pay more attention to this on a global level. But also the U.S. and Europe. I mean, the U.S. especially, we had, we who care about employment in the U.S., but it also affects the whole world. We won the two biggest policy changes that you can get in almost any country I know of, except for maybe North Korea, and that's monetary and fiscal policy. We had, with the Great Recession, we had 7 or 8 years of zero interest rates. We had 10 trillion in QE. We had, and then when the pandemic recession hit, we ran a 15% of GDP budget deficit in 2020 and 10% in 21. Never happened before in peacetime. And so that's really big. If we could, and the problem is, it's kind of like if we won Roe v. Wade and passed into law and nobody heard about it. And so when they came to take it away, nobody stood up. Okay, that's kind of what we did here, and it's kind of important, and I think that is one of the biggest things. Obviously, the Fed here is never going to, in the foreseeable future, care too much about the rest of the world. But they do respond to pressure. And that's why I think these things are so important, because there's other things I can go through. There were other things where the Fed was pressured and changed policy. And so that is really important. They do care, not because they can be thrown off or whatever, the things that Trump is threatening. He is really, you saw what he did to Lisa Cook and everything. But normally that's not the kind of pressure that work. The kind of pressure that comes from the public. They worry because when they go before Congress every, I don't know how many weeks it is, 6 weeks, I think. They worry that they're gonna look bad, and Congress is going to take away some of their much valued independence, which is really kind of a curse to the extent that they have the independence from the public. In my opinion, it's really they cost. Okay, I'll just say one last thing about it. They actually caused. Look at the article by Christina Roman when she was chair of council. Before she was chair of Council of Economic Advisors for Obama, and she went through all the Fed minutes, and she showed that they actually caused all of them post World War II recessions up to when we started to have the two bubble recessions and the pandemic recession. Just about. Oh yeah, she was a little bit earlier, then maybe one other. But really, almost all the recessions were actually caused by the Federal Reserve, according to her. And I think it's true. There are other economists who also supported her on that. So that's a huge problem in the world.
Much remains to be said about Fed independence. I know it was a big issue at the recent Jackson Hole meeting. Nakamura talked about it, among others. I want to use the remaining time that we have to open up the floor and hear some input from the audience for us to respond to. Start with Martine. Back also.
Great discussion. Thank you very much. One quick question for Brad. Brad, so you made a point that for low and lower middle income countries, private financing will be replaced by MDB's financing. And the cost of lending from the IMF and from the World Bank for non-concessional lending is also pro-cyclical, meaning that the interest rates increase when interest rates are higher in the advanced economies. Do you think the interest rate formula of these institutions should be changed? And if so, do you have any idea on how?
Should I just go ahead since I've got it? Since Gabriel. Okay, thanks. Yeah, so first of all, yeah, great panel. I want to, mark your indefatigable optimism is always welcome, I think, in a very dreary world. But since you are out there in Washington fighting the good fight, I was thinking that maybe we just put back on the table other issues about SDRs and IMF reform that we thought of in the days when we still thought there would be multilateralism. So I was a part of a board on effective multilateralism. The report got lost in cyberspace, like so many UN reports. But among the things we had said is that you really have to have a regular annual allocation, along with the increase in global nominal GDP, because that's the purpose. It was set up to be a global reserve. So obviously, global reserve has to at least move along with global GDP. And that would generate about $250 billion a year automatically. It would be an automatic annual allocation. We also said you have to have it selectively allocated to countries according to need. So weak external position, shocks that are beyond your control, like climate, terms of trade, interest rate, etc., and clear conditions to trigger very quick SDR allocation. We also argued for SDR swaps. The US Fed gives swaps to other countries which are friends and relations that it thinks would destabilize the US market, but really need global sort of financial safety net. And so the IMF should actually use SDR swaps as a means for this. Just putting it out there, I mean, very little chance of it happening, but since you're out there fighting and you think enlightened self-interest might win in Congress, let's hope so. I want to pick up also on this issue of the macroeconomic spillovers of US policies, which I think was alluded to a little bit by both you and Brad, and also by, I think it's true that most US policymakers have not really thought about it. I mean, Biden said, yeah, it's collateral damage, too bad. Okay. I do think that some of the recent policies are actually becoming self-goals. And specifically, I'd ask about the sanctions. It was okay, you could manage it when you did it to Iran and Venezuela and so on. Doing it to Russia, threatening it to China, etc., has really caused massive movement among the BRICS. So whether it is holding US dollar reserves or it is looking at other mechanisms of financial arrangement and so on, you're seeing a massive uptick. So I'm wondering whether, we didn't talk about dollar dominance, but whether all of these are also adding to the general perception that that period of US dollar dominance is on the decline.
So this is building something Brad brought up on the idea that China's capital flows in the prime Belt and Road period were pro-cyclical. So now that China is running these massive, trade surpluses and current account surpluses again, it seems like much of the international capital flows from the world would be emanating from China. And I was curious if you had a sense of who's really in charge of where that allocation is going, and if we know what the objectives of the Chinese policymakers are as they decide where these kind of $1 trillion of surplus are going to be allocated as capital leaves the country.
Stefano Battistoni, Zurich Invest. I have a question for Giovanni. So first of all, thank you very much for laying out this diagnosis that you made, which I share to a large extent. And towards the end, you said you made a list of what you would do, and in particular, you asked the question, who's going to do this agenda, who's going to push this agenda? So first question I have there is, what kind of institution do you think we should build, given the fact that trade unions is weak, social democracy betrayed,
and so on. So that's the first point. And then in order to understand which institution we need, maybe new institutions, and that it's linked to the kind of procedure that were before on, for instance, in particular for development, what kind of institution for developing countries. I find useful to, I also share your analysis of the fact that neoliberalism is maybe not over, but we are getting into a new version of it, an authoritarian version of it, which then brings me to the point that I find it useful to distinguish between neoliberalism as a design, and someone has already pointed to that yesterday, and the ideology that has been portrayed and given to the masses, and also given to all the professional economists in order to disseminate and implement that plan. Although the two are not different, because of course the plan is shift profits to large capital, but you can't say it openly. So my point is, going back, is it useful to the question, because the institutions that we may need in order to push that agenda have to take into account this distinction between the design and the ideology that's been given to the masses and also to the professional economists.
Thank you. So I want to give our panel actually a couple of minutes to answer some of these questions. And I'm going to maybe let people start as they wish. Brad, I think you have more than one. Why don't you maybe choose and go ahead and share some of your thoughts?
Sure. Very good questions. So, Martine, I'm not going to take the bait to reopen the discussion about surcharges and IMF lending. You all did a great job of highlighting that it is a real issue, and I certainly think that there's probably more that could be done. I will take the bait on the multilateral development banks, and I do think there are options for shifting to more fixed rate loans, shifting to lower cost loans. Those have trade-offs, so maybe I'll just kind of go through the trade-offs. The IBRD actually makes money. That's the reason why 25 billion of capital turned into 50 billion of capital over time. You could lower the charge and make less money. The IBRD also cross-subsidizes IDA. So if you lower the charges, you're going to have less money to cross-subsidize IDA, and there's more fiscal pressure if you want to maintain the same level of concessionality. But those are options that I think should be discussed. Certainly, I think one could imagine not relying on organic capital generation to raise the capital of the MDBs over time and thereby reduce costs. For using the SDRs, one idea that I had, and I really tried to make this a reality, co-wrote a paper with Brian Deese, who's somewhat plugged in, discussed it a lot with the World Bank Treasurer's Office, would be more or less, okay, those holding SDRs need a floating interest rate, which is going to be a little bit pro-cyclical if you lend at a floating rate. However, there is a swap market, and you could swap floating to fixed in the market with the World Bank as a counterpart. That is not a difficult financial transaction. It does have some capital costs to the World Bank, so you could shift that capital cost over to those who now have SDRs, who could buy an SDR-linked bond at a fixed rate, which would facilitate fixed rate lending. And then the people holding the SDRs could match their SDR interest costs with a swap themselves. All this gets really complicated, financing, yada, yada, yada. But the point being that there are ways one could credibly do this and generate long-term lending to a range of countries at a cost of between 4 and 5% fixed rate. You just really have to be kind of committed to working through a whole set of different financial problems and have a little bit of flexibility on the part of those holding reserves. So Jesse, I think we have a research project. What do we know about how the Chinese surplus is being recycled? Well, first of all, we don't even know the size of China's surplus of GDP. That's obviously wrong. No, so first of all, China's surplus has gone up to $600 billion now, which is 4% of China's GDP. Second of all, that is about half of what it should be based on the $1.2 trillion goods surplus and the fact that they should have an interest income surplus, yet they report a deficit in the investment income. Yeah, they do report a deficit on the investment. It's quite large. It is a mystery. The IMF has recognized it's a mystery. It's in the appendix of the external sector report. So I do not accept for a second that China's current account surplus is 1.3% of GDP. It is 4 in the latest data, and I think it's 6. Set that aside. The 600 billion is now being channeled through FDI outflows. So in some sense, it's being channeled according to tariff agreements because a lot of Chinese companies are investing quite heavily in Southeast Asia, other parts of the world to get around otherwise prohibitive tariffs. And then we're increasingly seeing it channeled through the state commercial banks. So we see a large couple $100 billion increase in the foreign assets of the state commercial banks, not the policy banks right now. So not CDB, not X. And it is very unclear precisely what the state commercial banks are currently doing. What we know is that they're buying bonds. So we see that. It's very hard because there's not much disclosure to know which bonds. And I actually think they are doing a lot of short-term funding for financial market intermediation. They're kind of like, that JP Morgan tower down there. JP Morgan does a lot of funding for like thesis trades, swap spread trades, basically financing hedge funds who buy long-term debt and then hedge in the capital markets. Those kinds of trades are very funding intensive. You need a lot of repo funding. I'm getting whacked. And I think in some sense, my guess is that the Chinese banks have become short-term funders to the global financial system. It is not showing up visibly in flows into dollar bonds, to treasuries. But I actually don't think that has anything to do with the sanctions. Just to conclude, China has not been buying treasury bonds for the past 10 years. China made a policy decision roughly around 2010 that they had plenty of reserves and plenty of treasuries. And since then, at the margin, the one thing we know, they've allocated their funds to other uses. Maybe that's financing hedge funds who indirectly buy treasuries. But the direct flow has dried up, which makes it a wonderful project for Jesse, brilliant global capital allocation project, which I love.
Giovanni, you had a question addressed to you. I'm not sure if you want to respond to that.
You're asking the difference between neoliberalism as a design and neoliberalism as an ideology. It's very difficult to distinguish because, it's like a religion. If you have the Khomeini revolution in Iran, it's somewhat difficult to distinguish between the design of society and the ideology that Khomeini spreads. I think that in order to vaccinate against neoliberalism, here is a modest proposal. Let us abolish from our discourse cost-benefit analysis. Because obviously all you know the cost, but the benefits are very difficult to quantify. You have got externality, we have got social effects that are extremely difficult to put a value upon them. I think, again, the metaphor of the war. You don't do the cost-benefit analysis saying, I want this weapon, how much does it cost, what is the benefit? If you decide that you want the weapon, no matter how much it costs. We have got social priorities that have got to be matched independently from the cost. And I think this is the first shot of vaccination should be that one. Who are the actors and what are the institutions? I leave it up to you. I don't have the answer. Certainly, one needs to have political mechanism to and organization that give a continuity to the request, the pressure. I mean, you have got a lot of movement around, but they come, maybe they are powerful, but they disappear over time. To give continuity to this social cause is, I don't know, that's it, but I feel the urgency of that.
Just a couple more minutes, and I would like to pick up on something that Mark mentioned in the end of his previous remarks, and kind of like, but open it up to anyone who's in chipping in. Mark mentioned, both the attacks on the Fed, of course, with direct global consequences, and talked about spillovers. Something related to that is the trends in inflation that we've all been watching closely over the last couple of years. The latest report that just came out a couple of days ago pointed toward a slight uptick, and has, a lot of people worried once more that maybe, Trump tariffs will show up now, maybe that things might escalate, maybe that a rate cut that many were anticipating in the September FOMC meeting might not be warranted against, what the governors have anonymously communicated to us in their infamous dot plots. So I just would love to hear your thoughts, Mark, on what to make of the situation we are in and the indicators we have for where inflation is headed with all its consequences.
Well, I think inflation in the U.S. is, it's not really a problem right now. It could, the tariffs could do something, but you have a lot of things going in the other direction. The unemployment rate is rising, and it's the Fed. That's how the Fed makes its decision very much based on the labor market. Even when inflation is coming from the labor market, they still operate on that quite a bit. We also have productivity. It looks like, if you look at the benchmarking with the BLS data, unemployment and what's expected going forward, in terms of revisions, it does look like productivity has increased significantly more. That it's going to come out. The productivity increased significantly more than we thought, 0.7%, which is quite large. And the Fed should take that into account as well, because that, of course, would keep inflation lower than we previously thought. But in any case, I do want to just address the two questions that you added just quickly, if that's okay. I think that because there's more about inflation, but that I could say, but let me just, because I think those two questions were really important. One will only take 30 seconds. I think, generally, the annual allocation is really important. And we should say that more, and our members of Congress that we talk to, every other day, are definitely for that. And, this is just getting the new issuance now is a step towards making that. And the sanctions, I think, are a huge question. I'm not going to talk about it for a long time, but I can say that it's first of all, it's a horrible crime. That's, so you don't need anything to say that it's wrong. It's really killing, it's targeting civilians. And actually, some of our members of Congress leadership in the Democratic, when the Dems had the House, actually said that they were calling for an end, and they had letters also calling for an end to sanctions on Cuba and Venezuela. And they say, and one of them, the governor in particular, said, you're targeting the civilian population. And that's really wrong. And that's what sanctions do. It's a regime change effort that targets, in most cases, that targets the civilian population. So, but it really influences all the other issues that we're looking at.
because it gives us power to the United States. And, nobody noticed it because it's not a bomb dropped in the marketplace somewhere or a wedding party in Afghanistan. It's people being killed without anybody seeing how they're being killed. And so it's really effective, and it really intimidates countries from trying to change policies in directions that the United States doesn't want them to go. So that's a bigger weapon. I think it's much bigger than the military right now.
Thank you very much. I'm getting polite threats from Gabriel. Thank you again to our three panelists, Giovanni, Brad, Mark. Thanks for sharing your thoughts.
Hey, I think we're just about ready to go. Do I have your permission, Samantha? Okay, great. Welcome, everybody. Feel free to keep eating and drinking while we start. We're going to be very timely and end at 2:30, so we have a lot of ground to cover. I'm Rana Farivar. I'm a global business columnist and associate editor of the FT. Very pleased to be here with IDP, with Joe Stiglitz, and with the entire group for what I think will be a great panel on market and political power in economics, AI, and the new digital rules. We were just saying earlier, it's a lot of ground to cover. It's a lot of disparate information, but actually, to me, it all fits together really well, because I think we're still struggling with the idea that power exists in the political economy. And so this area, I think, is where the rubber meets the road. I mean, I just have the image of Trump's inauguration kind of forever seared in my brain, with the big tech leaders sitting there in the front row with his family. We are in the middle of some very heavy head fakes with US, EU tariff talks. We thought that those had been resolved. Suddenly Trump is throwing in threats over digital regulation as a cost of doing business, and even potentially as a chit in dealing with Ukraine. And then I think that there's just the general but pervasive sense, and I'm sure many students that may be in attendance feel it, of where is AI going? What is it doing? We're already beginning to see higher than usual levels of unemployment amongst young white-collar workers. I feel myself, just in the corporate world in the last 6 months, there's been kind of a sea change here, and so a lot to talk about. I'll get started. I'm gonna introduce everybody, throw them a question that kind of plays to their passion points and allows them to do the presentations. And then we're going to be off to the races in a very interactive discussion. So keep your own questions to hand, and I'll give plenty of time for the audience to ask. So to my direct left, we have Clement Bohr, who is the adjunct assistant professor at UCLA's Anderson School of Management. To his left, we have Andrea Pratt, who is a professor of business at the Columbia Business School. We also have Lori Wallach, who is the director of Rethink the Trade program at American Economics Liberties Project, and Jesse Schringer, did I pronounce that correctly? Schringer? Associate professor at the Columbia Business School. So, Clement, I'm going to ask you to start. You've been thinking a lot about AI and labor markets, competition and free speech, which is, of course, all wrapped into everything I kind of introed with. But why don't you take us through your program, and then I may ask you a follow-up or two.
Thank you for that introduction, Andrea. And I also want to say thank you to Joe and everybody else who is here and has been part of this weekend. I'm one of the newer members. What I'm seeing is a pretty strong, broad community that surrounds Joe and IPD, and it's a real privilege just to be part of this broader community. So what I'm going to be talking about is a lot about how AI is going to affect inequality. But as we also know, there's a lot of dramatic talk about AI, and from more modest proposals to also very extreme hyperbolic discussions. And so what I'd really like to do in this quick discussion and talk is really try and make the potential scenarios what AI is going to do more concrete, so we can really have a more specific focus and discussion about what we can actually expect happening, but in a more historical perspective. And so I want to put out 3 scenarios, first of all, of how AI might affect the economy. And they go from more short-term thinking as the next business cycle to very long-term thinking for, perhaps the next inflection point in economic growth. But I want to stress that these aren't mutually exclusive scenarios. You can
very easily have many of these different scenarios happening at the same time. To start off with thinking about AI just in terms of what it means for the next 5 or 10 years, I want you to make the analogy to what we saw in the late 1990s with the telecom boom and the dot-com bubble. So this is a surge in productivity growth that might last for about 5 years or so, and we've seen this type of surge in productivity growth historically with a lot of technologies that have come before, specifically general purpose technologies. And these new technologies have also, almost without failure, even though they have real productivity gains underlying them, they do lead to this boom and bust because of a large surge in financial exuberance that then fails to actually meet the moment in terms of how fast the new technology delivers, and thereafter falling into a financial crash. And so we saw that all the way back in Britain, the canal mania back in the 1700s, and then the railway mania in the US in the 1800s, and then we go all the way up to the dot-com bubble here in the 1990s. And I'm sure most people in the room already know that a lot of the metrics to which we sort of measure financial exuberance and whether we're in a bubble-like scenario, they're very present right now in terms of record financial asset valuations, concentration in the stock market. We also have on the real side of the economy massive investment expenditures in these new technologies, although not the scale that's unheard of, similar to the dot-com and telecom boom. And then also Robert Schiller pointed out that with all these technology booms in the past, there's always this new era of theorizing surrounding all of them about this, they're always going to lead to this utopia and transform the world just around the corner. And so again, there's nothing new that we see today about the similar utopia that's waiting for us in 2027 with the singularity. On the other end of the scale, we have this idea that, well, perhaps AI is going to lead to an inflection point in economic growth. And to put that into perspective, Simon Kuznets pointed out back in the 1960s that there really was a structural break in economic growth in terms of GDP per capita in the mid-1800s. And so here I'm plotting the GDP per capita for France, Sweden, and the United States. And what you see is that, after 1850 or so, we grew steadily with fluctuations in the short horizon, but about 2% per year in GDP per capita. And the question is, this can't go on forever, so where is it going to go next? And putting AI aside, there are prominent economists like Robert Gordon who say that the transformation out of agriculture and the Industrial Revolution was uniquely transformative, and the productivity growth we got from that was unique. We shouldn't expect to see that type of productivity growth continue on in the future. And so eventually we're going to have this drawdown in GDP growth and productivity growth following that. You could also make a hypothesis for something more of the middle of the road. We've had 2% growth for a long time now, and perhaps there's a lot further to run on that down the road, and artificial intelligence may just be the next technology that will keep us at this average rate of 2% productivity growth for many decades or centuries to come. Now, I do want to stress that, what you see is that 2% productivity growth is really transformative in and of itself, right? So if you go forward 200 years, that would mean that the average GDP per capita in the US would be above $1 million, right? If you go back 200 years, relative terms, that's, that difference between now and $1 million is similar to what was 200 years ago and today. So from a person 300 years ago, where we are today would seem absolutely unfathomably, impossible. Now you have the AI apostles who say that, well, perhaps we won't just grow at 2%, but we're actually just at the dawn of a much higher growth rate, right? And so there is a reasonable argument to be made for this, in the sense that we've only grown about 2% a year for the last 150 years, which is a very short amount of time to actually doing this type of growth, right? And so perhaps as the human civilization, we've only really just started taking off in terms of economic growth. I think we saw a lot of discussion over the last couple of days that, we're still learning the ropes about what it makes economies grow and what it takes for economies to take off out of agriculture and to foster those institutions to actually make that happen. And so here we have these three different scenarios of that could happen going forward. Now, there's also a more middle of the road, which I want to spend a lot more time talking to you guys about, which is that, well, perhaps this is the next general purpose technology that will not just lead to a couple of years of above 2% GDP growth, but perhaps a couple of decades instead. And so the analogy we can make here is with the second industrial revolution, where we had Fordism and the switch from craft to mass production that brought about huge gains in productivity growth and also in terms of equality. And to describe this better, what I'm plotting here is the U.S. occupational shares from over the last 200 years, where flat collar refers to farming, fishery, agricultural jobs. Blue collar is the kind of traditional manufacturing jobs that you associate with the Industrial Revolution. And then you have these white collar jobs, which is professional and then business services. And
recording in progress.
And where you see in this trend line in terms of where we are with white professional jobs is it looks very similar to where we were around year 1900 with the Industrial Revolution and blue collar jobs, right? Which is far before we started seeing these dramatic declines in blue collar jobs. And so that's what I wanted to talk about next and draw that historical analogy for what AI would mean, okay? And so for the Industrial Revolution, here I'm going to describe it in terms of 3 phases, where I wanted to talk about the first phase as a creation phase of this new technology, where you see a rise in the worker share reduce in that technology. Then we have this routinization phase, which is where this job labor share is relatively flat and peaks. And then we have an automation phase where we see a lot of workers shift away from producing in this sector. In the initial phase of creation, this technology, whether it was the Industrial Revolution back in 1800s or software engineering and professional service over the past 50 years, required workers with very high skills and doing very non-routine tasks, which means that most of the gains that came from these new technologies went to these high-income earners that could produce these. And so we saw rises in inequality during these periods of creation, even though there was this new transformative technology. Now, eventually, these new techniques have been around, or technologies have been around for a long enough time that we've developed ways to let and enable those skilled workers produce a lot of these same goods at a high productivity rate. So if you go back to the Industrial Revolution, this is really the shift from craft production to mass production, where you had now low-skilled workers who are able to produce, say, cars at a much higher scale, at a very high productivity level. That was before associated with only craft workers in the little workshops where they build cars from scratch from the ground up. And as I'm showing you, highlighting yellow, AI looks like, from a historical sense, that we're at the same phase now, not where we're going to be displacing all these workers in the white professional class immediately, and we're going to automate them all away, but rather that we're actually going to have a lot of these professional jobs. Low-skilled workers are going to be able to produce a lot of them, and that's exactly what we see from what AI promises, right? Like it provides a level of expertise that's accessible to anyone, any day. It doesn't require someone like me up here to talk about it. Now, eventually, these sectors do get satiated, and we have built up a scale that the next step is to gain further profits, is to automate, replace the rest of the work away. And so again, this leads to a moment or a period where inequality rises relative to the previous phase, where we actually saw large gains in equality and productivity growth. So what we see really here is that technology over time really changes the skill composition of demand that the economy needs over time, and that has big effects on income inequality in terms of these phases that can either rise in over time or actually decrease inequality over time. And so the argument I'm making here is that perhaps we're actually at the phase where AI could lead in a lot of equality rather than inequality by making a lot of the work that was performed for high-skilled workers accessible to low-skilled workers. So I'm going to quickly wrap up. Here's just a table where I've laid out the previous technological revolutions in terms of agriculture, industrial, and digital, and show how they fit in to these 3 phases. And you can see at the bottom, artificial intelligence falls right into the second phase of routinization. And so, should you believe all the AI hype that is out there right now? Well, first of all, I would say no, in the sense that people are saying this time is really different, but we've been saying this time is really different during every technological transformation we've had in the past, and that has not been the case. But at the same time, as I mentioned earlier, that 2% growth per year is really transformative, and that can't be said enough. And AI surely seems like it's going to be able to progress that 2% growth, at least for the foreseeable future. And then lastly, I just want to reiterate again that there do seem to be large potential benefits for AI on the horizon. So rather than the pessimistic view, we could really see a lot of these high-skilled work go to lower-skilled workers and raise the income of the lower class, as well as then lead to large cost reductions in a lot of these professional services that will then become cheap and abundant, which were before really not in the budget for a lot of low-income workers. So thank you.
Awesome. Thank you, Clement. I'm going to ask just a couple of follow-up questions before we move on to the next presentation. One of the things I'm thinking a lot about is the political impact of this and the time frame that you suggested. Just a personal anecdote, I am working on my next book project, and really kind of as an opportunity to come up with a column, used AI to see if it could actually do a book. I didn't think it could, but it could act as a research assistant. So we get into that inequality piece of this. And my daughter, who's a recent University of Chicago graduate, and many of her friends are very, very anti-AI. And so I sense that there's a political backlash building. I'm wondering if you have thoughts on what that might mean in the midterms or what that might mean overall at this point. I know I'm asking you to swim out your lane, but that's...
I'm certainly not a political prognosticator, but I guess one thing I should have emphasized more during the talk is that there is going to be displacement of certain workers without a doubt, and I wasn't trying to put a too rosy picture on that. And that will lead to short-run political consequences, without a doubt. Yeah.
Hello? There I am. We'll come back to that. One final question. Why do you think, given the concentration, the fact that we just saw from a Chinese entrant into the market about a year ago, that it's very unclear whether the investment being made right now by the big U.S. firms is going to pay off? Why haven't we seen more of a correction yet, do you think?
Well, there was a famous economist who once said that the markets can stay irrational much longer than your own budget can, to paraphrase John Maynard Keynes. So, I said that it would not be crazy to see a bust and a crash in the stock market at some point, but you can never predict when it will come, whether it will be this year, whether it will be next year, whether it will be in 5 years' time.
Okay, well, Ray Dalio is saying 3, so we'll maybe we'll all go buy some gold.
I think one important thing I want to add to what you mentioned is that we saw these huge capital outlays with the dot-com and telecom boom as well, right?
Yeah.
And so even though there was a crash because we didn't see the returns right away, that still did lay the foundation for productivity growth over the next 10 decades after that with that technological infrastructure. So even though they're expanding very rapidly right now, that doesn't mean, that will likely be useful 5 to 10 years down the road, even if we're not going to get profits immediately from it the next year.
Okay, so it could be the AI is going to be a commodity. It's going to help individuals, depending on what area of the workforce they're in, but it may not end up being a fantastic thing for X company that's investing in it. Okay, Andrea, I want to move to you. And you've been looking at M&A, what happens when the big gets bigger in terms of sheer economic power turning into political power. This is a topic I'm fascinated by. So take it away.
Thank you. It's a pleasure to be here. And I completely agree with you, Giovanni, when you say that we need, can people hear me? Yeah. I completely agree with you when you say, maybe I can have the one. Thank you. Let me try again. I completely agree with you when you say that we haven't talked about power enough, especially economists. And I think Joe is one of the few exceptions. You've kind of pushed us to think about power much more than mainstream economists. Very close to my mouth. Can I ask if I do you know my? Okay. Let me try this. So what I'm going to try to do now is I'm part of a few economists who are trying to not just think about power, but try to quantify it. and the starting point actually goes back more than 100 years ago. It goes back to the origin of the antitrust movement. And when we think about antitrust today, we think mainly about market power, the power that firms have over consumers and maybe workers. But when the movement started, and Luis Brandes is one of the main people that come to mind, they thought a lot about political power. So if we look at this cartoon from the end of the 19th century, this represents Congress, and represents a Congress that's controlled by large economic powers, by the industries. So that's what they were afraid of. They were afraid that when firms become too big, they don't just squeeze consumers, but they try to manipulate the democratic process. And it makes plenty of sense from the perspective of a firm to do that. Because if you can change the rules, you're gonna have a much simpler life. So is it relevant today? Well, if we look at US lobbying, so this is the spending on lobbying in the US, 85% come from firms. So there is a sense in which firms are very active in this area. And now for the Europeans in this room, you're going to say, oh, but this is an American thing, like whatever, catch-up and the Second Amendment. No, it's not. If you look at lobbying in the EU, you find exactly the same large companies ruling this. And if you want to have some fun, you can look at a guide of Brussels called Lobby Planet, and it tells you where all the corporations have headquarters in Brussels. So it's a global phenomenon, and it makes sense. Now, this topic has been dormant, at least for economists, for about a century. And I credit Rajan and Zingales in the beginning of the 2000s with resurrecting it. And they thought there's a vicious circle. How does it work? You get innovation, maybe you get a new industry, AI, you get all these competitive players, the competitive players become successful, you get a large company, and then what the large company is going to try to do is going to try to capture the regulatory process. It makes plenty of sense for them to do so, and they will invest in political influence. So we should see that investment. And the goal is to keep away potential entrants and to then be able to squeeze consumers and workers. And Tim Wu, in his book on the master switch, provides a beautiful example of AT&T, new industry, telephone, long-distance telephone. They were very competitive, they become the monopolist, and then they put on all kinds of regulations that basically prevented innovations for decades in the US. Very good, but can we try to quantify this? So this is what we've been trying to do. Can we see if this is just a hypothesis or we can measure it? And how can you do it? Well, one thing is obviously larger firms are going to try to influence more, are going to spend more on lobbying. But can we see an experiment where we can say something more precise? And the idea we have is, let's look at mergers. Because when you have a mergers, you get two companies that all of a sudden become one large company. So you get a discontinuity in size, and can we observe something out of that? And so our idea is very simple. You have a pre-merger industry, for instance, here is an industry with three companies. All of them are exerting some influence activity, some lobbying, for instance. Let's be concrete, let's think about lobbying for now. Now there's a merger, A and B merge, and they become a large company that also has some lobbying activity. So one hypothesis you can look at is, does the new company spend more on influence activities than the two previous companies put together? That would tell us that there's something disproportionately large in that. And then you can ask more. You can ask, what about the third company? Does it become more active too? Because now there's more market power in the industry. And what about the whole industry? And so that's what we try to do. And now I'll bore you for just 3 minutes with what we actually try to do, which involves putting together a lot of data, because you have to put together data on mergers for about 20 years, data on lobbying expenses, data on firms and industries and on industry associations. And once you have all that data, you can summarize pretty much everything in this type of picture here. This is a picture where time zero is a merger. So it's a picture that represents two companies that were separate before, and now they're together. And on the x-axis, you have time. Each unit represents 6 months. And on the y-axis, you have how much they spend on average on lobbying. And as you can see, you get this jump right after the merger. They're spending much more. This can be, this was for lobbying spending. You can also look at contributions, and then you can run regressions, and you get an effect. The easier way to summarize it is about a 30% jump in spending due to a merger. Lots of other things you can do with this, and many of them would confirm what you suspect. This phenomenon is stronger the larger the firms involved in the merger. This phenomenon is stronger if the firms that merge are in the same industry. More market power, more search for political power. And these results hold both on the intensive and the extensive margin. One margin is they spend more on lobbying if they were already lobbying. But many firms in the US don't lobby at all. And what we find is that two firms that were not lobbying are also more likely to lobby, to start lobbying, to start sustaining the fixed cost of having some presence once they merge. This also holds if you look for firms that are not merging, and if you look at industry associations. So what can we conclude out of that? I think this is just very much the beginning, and it tells us that this is something that exists. The magnitude is large. This is potentially, in my view, one of the most important processes in our democracy. How is that going to evolve? It's very difficult to tell, because all of this is based on the idea that decisions in the US are made mainly in Congress. The system may be changing, and we have to rethink all of that. What would that type of process work? The other question is, what do firms use that for? What type of regulation do they buy through that influence? This is where our current research is trying to focus, is trying to figure out what kind of policies they get out of this. And finally, it's important to tie to a phenomenon that we've discussed a lot in recent years, which is the growth in concentration, in market concentration. So there is evidence, it's not entirely uncontroversial, but there is evidence that most industries are becoming more concentrated. What does that mean for the political process? Is it gonna become more concentrated too? And where is that whole feedback process going to take us? Thank you.
As you're speaking, it's occurring to me. I'm starting to think about the ways in which Congress has sort of eschewed many of its responsibilities, sometimes under pressure, obviously, but sometimes willfully. And one of those things would be antitrust. Another might be trade. Another might be monetary policy versus fiscal. Do you see a feedback loop where, because frankly, I see a lot of members of Congress that don't want to engage in any kind of guns and butter conversations about hard topics because they don't want to go afoul of the big donors. That then leads to more power politics, more money politics. How does this stop? I mean, where are the choke points, the trigger points that could actually be pressed on in some useful way? Big question, I know.
And a very difficult one. A small piece of the answer is what what about Congress? And one thing the AT&T example teaches us is that one way of being very successful here is to create agencies that then would be very subservient to the large companies. So that seems to be a very very efficient process to get this type of political power.
Also, where you think the legacy of the Biden administration in terms of antitrust is going to go at this point?
It's a huge question. I mean, when we started this process, antitrust was going in a very different direction. We were talking about much more enforcement, and now even the European Union is talking about less enforcement and talking about national champions. What this analysis kind of makes you think is that when we see mergers, we should not just worry about the effect on consumers and workers, which is very important, but we should also keep in mind that we're going to have a larger entity that's going to try to influence the democratic process. And so this creates one more reason to be tough on mergers. The world is going in the opposite direction.
Lots more to ask, but I want to move on to Lori Wallach, my good friend. Lori, we didn't have a little pregame about your presentation, but if anybody thinks about power, particularly as it comes to trade and tech, it's you, my friend. So I'm just going to let you riff on whatever points you want, and then I'll jump in with questions.
I'm going to pull this way down here because I have the opposite problem of Andrea. Well, thank you, Rana, and it's an honor to be included in the IPD's 25th anniversary celebration. I'm going to flip this down so people can see me over the top of it. Joe, as the lead ambassador for IPD's brilliant work, it's been an honor to watch your brilliance, your energy, and your cheerful relentlessness operating simultaneously, which is incredibly rare with respect in the policy circuit of Washington, in international agencies and on their leaders, and then also simultaneously in numerous national capitals and with different governments all at the same time. And it's had an enormous effect. I've seen it personally in different and new areas and venues, and it's very rare to be able to operate effectively in those three venues simultaneously. So thank you. And for the whole IPD team that is behind a lot of that research that you are so brilliantly communicating, thank you to all of you. The topic I'm going to focus on is this issue where basically power and tech are smacking into each other with the global economy. It's an increasingly worrisome feature of the global economy, and it's a place where big tech's political power is translating into potentially legal limitations on governments in a way that has dramatic effects beyond the usual rent seeking. And I think this sort of notion of the political power is exactly the point to be made about this, because when it comes to tech, not just AI, but literally where we get our information, how we communicate with each other, what reality is constructed for us, how our democracy can function, to say nothing of the AI piece, the role of the large tech platforms is different. It's all of the issues of any big companies, and then it's yet a different level of potential threat. And what I am going to talk about a little bit is the ways in which the largest tech platforms, particularly in the US, are trying to hijack trade language, policies, platforms, negotiations, laws, to try and lock in constraints on policy regulation of the big tech firms in numerous different ways, the oversight of how AI is developed and deployed, and as well trying to increase and lock in their power. And I want to make a footnote. I'm going to talk about the US firms because it's something ostensibly I have some ability as an American to fight about, but it's not unique because the large firms and the Chinese government have a different set of sort of rules and intentions with their biggest platforms. Those are the places of the two biggest platforms, and they are differently problematic. They are not no regulation of big companies. It's much more the government is micromanaging lots of bits of your information, etc. But in either instance, the implications are enormous, and if these policies are locked in, cross-linked to financial and economic leverage, such as tariff, market access, etc., it becomes a very perilous situation. So, number one, a lot of people here know this, but one of the issues we have to focus on was the asymmetries of rulemaking in the global economy. It's not just between large and small countries, but interests. And I want to flag for the people from other countries who aren't aware how much there is an intentionality with the US big tech firms to exploit certain structural realities to basically use trade as a backdoor hijack mechanism to push this political agenda. Not the least of which is, I would like to refer folks in these slides. Please get these slides either from me or Gabriella and the team, because these are all links, all of these studies. We did an analysis called Loaded, where we took 500 official U.S. corporate trade advisors who are statutorily created. So footnote David Kennedy, yes, sometimes the legal system is actually created the political and economic reality. We have given official privilege to, of these 500 advisors, 87% are corporate, and we have statutory secrecy for a lot of this information. So we've created a platform to make policy that is directly exclusionary of those who will live with the results. And obviously, if you put it in a trade agreement, you've locked in the rules. You can't change a comma without consensus of the signatory parties. So countries beware, as the Trump administration is trying to get you to sign things, think carefully. These are binding and enforceable when the WTO enforcement mechanism was in place directly. But this is where the big small dynamic comes in with trade sanctions as well. And then, it begs the question of in whose interest are any of these moves. When the EU was blowing up the TRIPS waiver, it certainly wasn't in the interest of their public to not die from the zombie apocalypse of COVID, nor is it in the interest of most people in the United States to have the big tech companies actually have more power. Because, of course, Donald Trump did campaign announcing that what he would use his tariffs for was, help big tech abuse our kids and bust small companies even more, and also to help people have coups in Brazil. He didn't say anything about, manufacturing. That, for anyone for whom English was their second language, it's a bitter joke. So we now have big tech borrowing from big pharma's playbook. We saw how big pharma locks in a 20-year monopoly patent, so classic rent-seeking protectionism in the trade agreements. So now, starting with the Trans-Pacific Partnership, you have U.S. big tech companies, their lobbyists are trying to insert these kind of rules into trade agreements. I would like to refer everyone to an astonishing paper by a then PhD student as part of a dissertation named Wendy Lee, L.I. Please Google it. She had been a junior phone answerer at the U.S. Trade Representative's office during the Obama administration, during the Trans-Pacific Partnership. She became friendly with all of the tech lobbyists trying to talk to her bosses. She then was working on her PhD and was able to interview them and get them all to brag to her on the record how they created the digital trade brand and used it to stealthily Trojan horse all of their rules into U.S. trade policy. It is an astonishing paper, and the original interviews lay out in a way you don't normally see the actual lobbying tactics of a very sophisticated industry taking over an issue. Now, what they were able to achieve originally was a very subtle system of international preemption. And I'm going to explain some of these terms of art and translate them out of the legalese for my economist friends, but they've now gone crass, and they literally have Trump threatening tariff violence if a country doesn't back up with its particular tech regulation. There is happily only one set of these rules actually enacted in U.S. law and approved by our Congress. It's with the U.S.-Mexico-Canada agreement. So the cement has not hardened. Most countries do not have these rules, and that is a good thing. So what are these rules? laws. I'm not going to go through all of these slides, but with the notion that folks can get the slides, I have various versions of what they cover. The basic notion of them, and this starts for what the impact is and then explains what the rule is there is a threat to AI oversight, online discrimination, etc. This also is a rule that undermines right to repair, so as competition policy, disgorgement of information in databases as an antitrust remedy, which our Justice Department does on the regular with tech companies, as well as all of the AI oversight that one would want. It is new secrecy guarantees for algorithms and for source code, which footnote the actual secrecy rules you actually need exist already in the WTO TRIPS agreements, rules that actually have trade secrets rules, which is the kosher version of this as compared to the abusive version of it. This is sold as, just to translate from the legalese, this is innovation protection. This is new secrecy just for these couple of areas of intellectual property, just for big tech. Called, if you can imagine, non-discrimination is the third one there. It is a ban on competition policy and many other laws that could have an impact on larger firms, even if it is neutral vis-a-vis national origin of the company or the investor. This is where they go after things like the DMA in Europe, but also the Open Access Market Act in the US, which is a replica of Korean and Japanese App Store competition policies. This is where they go after, for instance, something Anya's worked on a lot, the ability to have a media bargaining code where the big tech platforms are required to actually compensate for the data that they use as an antitrust balancing mechanism. There's a law in the US, JCPA, that's been reintroduced based on that. Plus, in some of these pushes and in the USMCA, there is the tech platform liability waiver that would make things like the DSA and the legal trade barrier. So just because this all seems overwhelming, they also then do it the other way around. This provision of that explain the, because some people think about this legalistically, other people think about it operationally. The good news is we have over the last 3 years created an entire body of literature unpacking this. So each one of these studies that is in one of these slides is a hot link. This one goes literally through each of the rules, explains which US laws are at risk and which European, Japanese, Korean, Brazilian, other laws the US copied, because we're behind the curve, in making the laws that are at risk. Just lest anyone think I'm exaggerating, on the regular, the big tech companies and their trade associations actually write this stuff down. So another study, again, the link on the bottom, is a study where we actually looked at an annual report called the National Trade Estimates Report that has U.S. companies listing what they think for the USTR ought to be deemed illegal trade barriers. We just quantified the number of attacks against global digital competition policies in this particular study by nationality and flag. They're not shy about it. You can actually see this is the agenda that they are pushing. So the notion of digital trade, their brand, or things like calling policies that, are very weaselly words, but non-discrimination, that's a true trade concept, bastardized for this particular use, both in the legal rules, but in the notion that any law that has a different impact in a big company is an illegal trade barrier if the big company happens to be foreign. So that makes all competition policy, or where you actually target by dominance in the market, impossible to implement. Similarly, there's a set of rules that they call pro-free speech, anti-government snooping rules, and those are all the rules that have to do with data flows and the regulation for data security and privacy of data flows. The big tech firms have basically turned all of these things sideways, and unfortunately, over the arc of time, the Biden administration did push back. There's a great foreign policy piece that Joe did celebrating the 2023 pushback by the Biden administration of an attempt to get all of these rules locked in the WTO. That was successful. These rules are not in the WTO. The European Union was fighting back. Other countries were fighting back. That momentary disaster was passed. But crushingly, 6 months ago, the African Continental Free Trade Agreement for 55 countries has all the most horrific USMCA style rules, which, by the way, there's an analysis of who has these super extreme rules. Now it's 55 sub-Saharan African countries. Previously, it was basically one US agreement, Singapore and some agreements, and almost no one else. So these companies are on the march trying to formalize these weasel words into new law. And now it's got even more crass, where you have a direct tariff threat by the president. Here are some of his policy making by social media. These are Truth Social posts where he basically threatens, if you regulate, I will tariff you. The first one was before the Supreme Court took up the tariffs case. So the second one's an escalation, because it could be that the existing tariffs could be ruled illegal, so then they'd have to use a different statute. So number 2 goes after the new statute. Yes, I will use a different statute, Section 301, if you dare to regulate. So this is now posing enormous implications, obviously, for global governance, for democracy, for the economy, because we can't have these giant platforms with all of their beyond economic power implications running rampant with no oversight whatsoever. So these quotes in blue italics are 2 things that we tested in public opinion research, which is, by the way, we've already seen the data, we formulate these questions, but one of the few things Americans agree on across the country, Trump supporters, independents, and people on the left, is that big tech has too much power and they're using it to abuse people. So it is interesting to translate my starting joke into practicalities of how there's a possibility for pushback. Domestically, at some point, he's going to catch up to Trump that the agenda he's using the tariffs for is not the ones that he sold them for, and moreover is pushing for the benefits of an entity that many Americans really dislike. What is the pushback tactic for people in other countries is where I would act. And I would say, number 1, looking out for the legal march, not just, for instance, for the Africa Continental Free Trade Agreement, but also the push with respect to a variety of bilateral, regional, plurilateral agreements. These tech companies are relentless. They have people everywhere, huge teams of them lobbying, trying to get these rules made formally. As well, with respect to the direct threats, I think the key thing, well, just one cynical footnote for all my European friends, his being such a bully and such a boor has actually put some starch into the shorts that appears in DG Trade, because unfortunately the Trade Department of the EU was just in the process of rolling back what were very good rules that balance the need for free flows of data, but also even the need for privacy regulation. And sort of in the classic fight between parts of the EU, DG Trade was about to sell out DG Privacy, DG Competition, and basically Trump was so vulgar that it appears that Sabina Weigand has temporarily been put back into a chair. However, there is still a big push where, for instance, we have, thank God, seen officials in the EU saying, no, they're not going to cave. But my advice is, number 1, go very carefully to see whether or not it's basically caution, because there's uncertainty about the status of the future tariffs, so the threats may or may not be deliverable. To the extent that delay in discussion ends, then number 2, it's worth thinking about pushing back. I do want to flag that I recognize China's escalating response on tariffs is different than fighting back on a policy issue, yet taking the footnote of understanding the way the Ukraine dynamic has undermined it, the European Union and others who are big players, like the European Union does have their infamous trade bazooka. It's a countervailing measure to use like a Section 301 in the US. It'd be very interesting to see how well bully Trump would stand up if some other countries with might and with size were threatening to blast, as we saw what happened with China. Now, again, it's tariff for tariff. That wasn't tariff in the policy space. I can't promise that dynamic will prove true, but I also understand the geopolitical limits. In the longer term, I think the key thing is diversification of the tech stack, so that there isn't such enormous pervasiveness of the US or Chinese biggies. And that is something we need for healthy democracy. It will take industrial policies. It will raise all the issues of financing that. as well as very strong competition and other legal safeguards to develop those policies. But the choice can't be between the US big tech, no regulation, and the Chinese. We will have our tech firms sorting through your daily life, your underwear drawer, and exactly who you're talking to. Alternatively, I think that's the answer as well more broadly for trade. And this basically closes where Jayati literally is the first speaker on the first panel started, which is the quandary of why is it that the United States has so much power to be such an enormous bully? And I want to just flag, with $1 trillion of trade deficit, it becomes very hard for other countries to quickly figure out where they're going to send all of those imports. If there was more diversified trade patterns, the U.S. would have less leverage, so that if we threatened to cut off the U.S. markets, it would be less of a matter of total panic and potential global collapse for another country if another country is not so reliant on sending exports to us. So it's the idea of, and people have talked about this throughout this whole 2-day period, it's diversifying regional trade. And it's building supply chains, which we need for our resilience and to face the climate crisis anyway, that are not economically efficient, but have some replicas, and that distribute trade so that you have less of the global imbalances that now have 22 countries with chronic large surpluses with the world, and now have more than 60 countries, Mexico, Brazil, India, joining the U.S. as chronic trade deficit countries with a lot of reliance into the U.S. market, first and foremost. So I'll stop there. And for people who really want to get into the, for people who really want to get down into the weeds and also have the hot links to each study, I put at the very end slides that obviously we didn't have time to go into that go through each one of the rules and shows you how to fix them, where the actual problem is, and then which European or other countries' laws. So each of these charts will explain the U.S. law, the European or other countries' laws that was used for the law, and then the ones that we have long studies on has the study as a link. So we've pulled out all the hypocritical things, like just footnote, the U.S. limits data flows and requires domestic storage of data, at the same time that we're beating up countries that do that for security purposes. Or Texas just passed a data flows limitation rule for the state. There are 17 Republican states that have right to repair laws that violate that source code secrecy rule. So all of these slides go through all of this with hot links to the details. Thank you.
Awesome presentation, Lori, and I want to get those slides from you myself. Let me ask you a couple of simple questions, then maybe one more complicated one. At the beginning of the Trump administration, even though we had the visuals that this guy is in bed with big tech, he cares about the market, you also had the MAGA front, you had Steve Bannon, you had, Vance, who knows where he is, but there was a sense that there might be an anti-big tech contingency. Is that still at all real, or is that, and can it be usefully deployed in any way?
That is the $64,000 question. Because for people who aren't from the US, there is a very strong right-wing anti-big tech movement that continues to exist. It has a different analysis of what the problems are, but bigness is at the root of it. How that then plays out and what they're irritated about that bigness is different than I would say most progressives perceive it. But bigness is at the root of it. And there are a whole bunch of neo-Brandeisian, super right-wing people who disagree on a lot of things, but they think the structural power problem. Those guys have had a shocking turnabout. And they're certainly trying to figure out a path back, which gets to number two, which is broadly what was going to be MAGA antitrust. What was going to be MAGA antitrust, which everyone was very excited about, was quickly diminished by the most, I would say, crass pay to play. So literally what's happened is there are a couple of people who are close to Trump personally, who have over whoever gets to him last, who calls him on his cell phone, who hangs out at Mar-a-Lago, who's at a dinner, who gets to one of his friends who gets to him, has basically convinced him in lots of areas to do things that just totally contradict the overarching set of what he claims to have as his principles and goals. And in the big tech space, it's a mystery because, relatively speaking, the amount of cash they have put on the table, even with their golden statue, even with their $1 million contributions to the inauguration, it's chump change. It's rounded. It's like an accounting error on the paperclip fund. I mean, it's nothing. And so why it's become so pervasive is a mystery. But it does suggest it may not be permanent. But right now, it's very stuck.
Okay, interesting. And then second question, you sort of alluded to this, that Europe has more firepower than it may think. What would, you're a strategic thinker, if you were Ursula von der Leyen right now, what would the play be for what's happening, where you've got pressure, again, on tariffs under threat of regulation, Ukraine is in the mix, what would be the kind of 1, 2, 3 move that you would make around tech, trade, and security right now for Europe?
That is above my pay grade. However, some things I would advise such a decision maker. Number one, I would observe that unlike the threat to use Section 301, which refers to a part of the Trade Act of 1974 that allows with enormous discretion the U.S. to impose tariffs, it's another methodology. So the U.S. Constitution gives exclusive authority over tariffs to Congress. There has to be a delegation. The thing that's in the Supreme Court is a certain law allowed as a delegation, maybe, maybe not. Section 301's been tested, and it is allowed as a delegation, but it takes more time to get to it. All is background to say, the president threatened a Section 301 attack on Brazil on behalf of, seeing himself in the future being Bolsonaro on trial. And so, in footnote, we have a trade surplus with Brazil. So that's really with Trump's strategy of balance of trade. But he threatened the 301, and literally the next day they posted notice for comment, and they've had the hearing already. So they're like, it's on a rocket docket to get it done. He threatened the 301 2 weeks ago. Now, no action. So the first thing to see is how much of it is hype and screaming and how much it's actually action. If they start to go to the notice of the 301, the other thing I would say is even if they're cutting the corners, it's a good 7 months before a tariff can come out, and who knows what would be the circumstances at that point. Please God, peace with respect to Ukraine. But it's just, I would say, the bullying factor, a lot of it needs to be negotiated and discussed. A big question is what happens with those IEPA, the other tariffs. If the Supreme Court limits the authority, I think there's an enormous greater amount of flexibility for every country getting threatened. If the Supreme Court allows that, then heaven help us, because it's also, besides a trade issue, a huge balance of powers issue in our Constitution.
Okay, that's very interesting. I think one thing that we haven't brought up and should is, you mentioned timing, who knows where things are going to be in 6 or 7 months. The economy is possibly going to be in a very different place, and his ability to do anything with tariffs may shift. Okay, TBD. Jesse, I think that this is well curated because you're all about geoeconomics, and that's where we are right now. So why don't you give your presentation and then we'll jump in.
So thank you so much, Joe and IPD, for the invitation to be here. This is actually going to be talking about how you measure geoeconomic pressure in reality, in the data. Our theoretical work over the last several years has relied heavily on Greenwald-Stiglitz externalities. So it's another great reason to be presenting it here. But the starting point for today, for my remarks today, is really about how we can actually measure the shift in the global economy towards kind of this era of, say, geoeconomic competition. And so what do I mean by geoeconomics? Hegemonic governments, the US, China, using their economic strength from existing financial and trade relationships to achieve geopolitical and economic goals. So in this room, I barely have to motivate these. US imposing export controls on semiconductors in China. China threatening to cut off the supply of rare earths. The Trump administration throwing around every kind of tariff threat in order to change the behavior of countries. Now, as the world has moved towards this kind of geoeconomic competition, there's this open question of how exactly are firms being pressured and how the pressured firms actually respond. So why is this a challenging thing to do? So pressure can be indirect and it can use different tools. Kind of building on some of the recent discussion here, firms may be changing their behavior because they know that there's going to be, say, pressure from the White House if they don't. You might not actually see a new policy institute. Changes in the target behavior may be multifaceted. They could change their lobbying behavior in response to the expectation of tariffs, sanctions, or export controls. And you can't just look at, say, who does the U.S. actually sanction? Who does the U.S. actually put export controls on? Why? Because so much of the power of geoeconomics is that the target may actually change their behavior. And so they may actually avoid the sanction. So what are we going to do here? This is going to be about how you can actually use large-scale AI to measure how firms all around the world are being pressured by geoeconomics and how they're responding. So let me show you how, in one slide, how we're going to go about doing this. So in order to measure how firms are being pressured, we need some sort of text on what they're doing. So we're going to take 800,000 documents, the universe of earnings calls, investment bank analyst reports, country sector reports on basically every publicly traded firm anywhere around the world, including a new data set that covers the universe of Chinese publicly traded firms. We're then essentially going to treat this as if we can run a survey on all of these companies using local GPU infrastructure and open weight large language models so that everything is replicable and inspectable. What are we going to do? We're essentially going to ask all these firms in their documents, were you affected by tariffs, sanctions, export controls? If you were, who imposed the policy? What country is targeted? Was it the products that you bought that were targeted? Was it the products you sell that were targeted? How'd you respond? Did you raise your investment? Where? Did you adjust your supply chain? Who'd you move it towards? Who'd you move it against? And so we can actually go document by document using AI to measure this universe of geoeconomic pressure. And so let me give you an example of what this would look like. So a famous case of the US applying geoeconomic pressure outside of its boundaries is the case of ASML, the Dutch producer of semiconductor, essentially machine tools. So when the Trump administration originally said we are going to basically cut China off from semiconductors, they very quickly learned, well, actually, the US doesn't produce the machines you need to produce semiconductors. Instead, you need to cut off ASML. So how, in particular, did the US do this? They threatened to impose the foreign direct product rule, basically crippling ASML, unless ASML stopped its China sales. So when we actually ask, the analyst reports and earnings calls of ASML, well, who's actually imposing export controls on you? At first, they're going to say the US. Eventually, the US government pressures the Dutch government into joining along to get the Netherlands there. You always see, well, which country is receiving these controls? China. Which of your products are targeted? Extreme ultraviolet lithography and deep ultraviolet lithography systems. Was it good or bad for you? It was bad. Why was it? How were you able to adjust? This is a case where the firm essentially wasn't able to find another market. They just said, you know what? We're going to sell less to China. Okay? Additionally, we can actually see the Chinese firms that are hit by this. So this is kind of one example. To kind of convince you that an LLM is not delivering pure garbage, let me show you what happens when we actually aggregate up sanctions. This is asking every single publicly traded firm, were you affected by sanctions? And if so, who imposed it and who was it on? And you can actually see the changing time. So if you go back to 2013, purple, that's the US imposing sanctions on Iran. You go to 2014, in the wake of the Crimean annexation, it switches to being American sanctions on Russia. You go to 2019, you get American sanctions on Iran after the pullout of the JCPOA and the rise in sanctions on China. Then we go to the sanctions on Russia after the invasion of Ukraine. For export controls, you can see originally in the 2010s, it's all about China pressuring Japan by cutting off rare earths in the wake of the territorial dispute. In the Trump administration, we moved to the US using export controls against China. And then finally in green there, you can start to see China applying pressure to American firms via threatening to cut off rare earths. Tariffs, we all know the time series. The US putting tariffs on. So, what can you actually do when you're able to take kind of this large-scale AI infrastructure and ask firms how they're being, affected? to us, the most exciting innovation of being able to use this kind of AI infrastructure is you can get to something close to a causal effect. You can ask firms, how are you being affected by tariffs? And you can ask, how are you, or sanctions or export controls, and you can ask how you're responding. So the simplest one is, firms, are you being positively or negatively affected by these three geoeconomic tools? Well, overwhelmingly, firms that say they're affected are negatively affected by each of these three. But what's interesting is you have this heterogeneity in terms of why they are going to be negatively or differentially affected. When you ask firms, well, what happened as a result of tariff sanctions or export controls? For tariffs, you see firms across the board saying, I'm affected because my input prices go up. They increasingly say their sales prices go up. By contrast, for export controls, instead you see more and more firms say that, in fact, they're going to be raising their investment and their R&D. You can see kind of similar effects for input sales and profit margin. But what's exciting about this, you can actually dig deeper to understand how firms are going to differentially respond to this type of pressure. You don't have to say, oh, are you affected by tariffs? You can say, well, which country is imposing this pressure? And so you can ask, let's say it's American firms imposing the pressure. On the left graph, this would say, if the US is imposing pressure, then the firms, if you're saying that you're affected by American pressure and you're an American firm, you're based in the firm imposing pressure. And so now you can see how differently, say, an American firm would be affected by tariffs. Overwhelmingly, firms in the country imposing tariffs are going to say, well, I'm hit by hugely rising input prices in addition to increasing sales prices. To us, the strongest and kind of most interesting finding in terms of how are firms responding to pressure actually comes in the right point. When you ask firms in countries receiving pressure, how are they changing their behavior as a result of this? You can see that when you are hit by export controls, what are firms actually doing? They overwhelmingly say, we are responding by increasing our research and development, and we're increasing our domestic investment. This is coming from Chinese firms answering, what are you doing in response to being hit by American export controls? That's what they're doing. They're raising investment in China, and they're raising their R&D. You can then say, okay, firms, are you changing the way in which you structure your supply chain? Here, this is just in response to American tariffs. You can say, if the firms say they're changing their supply chain, you can ask them, which countries are you moving towards? Which are you moving away from? So first, for American firms, overwhelmingly, you actually see the main response is in response to US tariffs. Firms report moving away from China. However, you all are also seeing some of the intended effect of policies, one of the potential effects. American firms are disproportionately likely to say that they're actually moving their activity towards the United States. Let's contrast that with how Chinese firms respond when they report being affected by American tariffs. They report not only moving their activity away from China, they also report moving their activity away from the United States and instead say they're going to Vietnam, Thailand, and Malaysia. Now, the last thing I really want to look at here is how you can actually use these AI tools to give kind of a real-time assessment of how firms are responding to ongoing events. So here I'm going to zoom in on the ongoing trade war. Here we look only at American firms, and we start with a simple question. Are you being positively or negatively affected by American tariffs? So overwhelmingly here, more than half of American firms say they're being hurt by American tariffs. But interestingly, we are at the all-time high of American firms saying they're being positively affected. We can actually dig in and say what makes these firms different. So we can split American firms into whether they self-report they're positively or negatively affected by tariffs. So first, it's a sanity check. The firms that say they're negatively affected by tariffs also report their profits going down. The positively affected ones say they're going up. How could it be that some firms are losing and some are gaining? Well, if you look at the left column for input price, the firms that say that they're negatively affected are the ones that disproportionately say their input prices are going up because they're buying foreign inputs. A little bit, much less so for the positively affected firms. But what's striking is that both positively and negatively affected firms report raising their sales price equally. When you dig in, how are American firms being positively affected? What are they saying? Well, they are saying all of our competitors import more foreign products than us. They are forced to raise their prices in order to keep up with their costs. We are able to raise our profits and keep it as a market. Our profit share is going up. So you can actually dig in real time and see which firms kind of at the micro level are affected kind of in real time. And so let me actually add here, as we see the world kind of moving to this era where countries are increasingly willing to use these tools, not just in response to, say, major events like the invasion of Ukraine, but as a fairly common policy tool, thinking of the pressure on Brazil and India right now, we really think it's important to be able to actually put a measurement in real time in who is actually bearing, who is actually affected, and we think most importantly be able to say, how are firms adjusting their behavior to this kind of pressure, firm by firm, country by country, all around the world. So thank you very much.
Awesome presentation, Jesse. So I have a question. I was at a big CEO conference in Europe about 6 months ago, and a lot of major players in various industries. The top one or two in each group would have said that they could more or less offset 15% tariffs with supply chain optimization. And that's very, very different than what's happening with small and mid-sized businesses. So it seems to me that the age of geoeconomics, or resiliency, if you want to call it that, or fractiousness, pick your verb, is going to preference the big. Is that what you're noticing as well?
Generally, you see the largest companies saying that, in the Chinese case, you'll see kind of the major players saying that they're able to raise, their R&D. Within the U.S., it really is more mixed in the sense that, especially for tariffs, the difference really does seem to come down on how exposed you are to the rest of the world versus your competitors. However, given the structure of the tariffs that Trump has imposed, it's not a simple flat tax. There are so many different ways to get around them, including the ways that Andrea kind of outlined. The more complicated the tariff arrangement, the more ways in which sophisticated large firms can presumably avoid them. And so I have a feeling that because of the different bilateral tariffs and the different intricacies, complexity favors the large.
Okay, yeah, I want to come back to the complexity issue in a minute, but let me ask you also to kind of judge who's doing geoeconomics better at this moment, US or China? And just a couple of observations. I mean, I look at what China is doing with its economy, it's actually doubling down on manufacturing. That's going to involve, that already is involving, dumping things in Europe that can't go in the US. The US, if you read Steve Marin's report, has this very tiny needle it's trying to thread to somewhat weaken the dollar, not crash the market, prop up the dollar with crypto. I'm not really sure how that works, but there's a lot of machinations. So what do you see that's actually smart being done here from a kind of selfish point of view?
So I think the key in terms of countries figuring out where they actually have power to pressure others is really the question of, if I take something away, how much damage can I inflict on the other country relative to what I bear? And so there are a few ways in which it's essentially the inverse of the gains from trade. Okay? Now, what would make a good that's supplied painful to take away? One, it's a big expenditure share of the country's receipt. Fine. Technologically, it's hard to substitute away from. Take that away. But we think kind of the most, I think the most overlooked and I think maybe the most important is, are you a monopolist in that good? Because if you contemplate taking away a good or losing access to it, the question is, what's the second best version I could go to? And so let's think the case of oil. If a country that exports 10% of the world's oil suddenly threatens not to sell oil, well, fine, you'll buy it from somewhere else. It's pretty high elasticity of substitution. You can switch to the second best. If you have a cartel and you're able to take away all oil, suddenly you're saying, how painful is it to switch from oil to natural gas? Now, in the case of the US and China, they are monopolists in very different types of goods. Rare earth seems to be the one that China is nearly a monopolist in. And the US, the only place where it was a near monopolist is in the world of international finance. And it's a near monopolist in the world of international finance when it keeps the coalition of its friends on its side. The US alone is not a monopolist in international finance. And the reason why we think financial sanctions coming from the U.S. has such kind of a large bite is because when the U.S. and allied countries act together, there is no alternative to go to. As the U.S. acts unilaterally on all of these policies, where the question is who is the American ally, I think the U.S. is going more and more towards kind of undermining its ability to do that. And of course, the more you use any of these, the more conscious, the more flagrantly you use these, the more other countries move away ahead of time. When early in the Trump administration, the U.S. essentially threatened Colombia with a financial crisis unless they accepted migrant flights, threatening tariffs and full financial exclusion, it's essentially malpractice for other countries to have not tried to insulate themselves from that kind of threat. If financial Armageddon is threatened for accepting migrant flights, of course it's going to be threatened.
Okay, this has been such an interesting group of presentations. I'm going to try to thread another very fine needle and ask a couple of big, broad questions that I think you can all weigh in on, and then I think we'll open it up to the groups. There's so many places we can go. Let's just, taking this topic of geoeconomics and who has power and how it can be wielded. It has often seemed to me that there are more vectors in play now than there have ever been in my 33-year journalism career. You have, even if you pulled, say, Trump and some of the wild cards out of the mix, you have a lot of signals that we may be coming in for a big market downturn. You have a lot of leverage. You have a rise in power, a new great power conflict. You have a potentially transformative technology. You have demographic shifts. If you all, I'd like to just kind of go down the row, could maybe sketch a scenario for the next 3 or 5 years and bring in some of the points that have been made about who has power and who will the winners and potential losers be in the world as you see it right now. So we'll start with you, Clement.
That fits very well into something I wanted to point out that I thought was really notable about Jesse's presentation, which is how Chinese companies reacted to the chip embargoes that they faced, right? Where we saw that they massively invested in domestic production and R&D, which I really think shows this temporal dimension to this issue, which is that type of exercise in geopolitical power really seems incredibly short-termism in its goal, right? Because what we see now, right, is we have Huawei, who has developed a lot of technologies and features to produce these chips themselves. And so what did we gain along the way beyond, maybe a couple years of getting a couple steps in front of China in this development in the AI arms race? So, it seems like it's a self-defeating way to gain leverage and exploit the rest of the world. And it begs the question, well, if the long term is the right, I know you're talking about 3 to 4 years, but I mean, I don't think 3 to 4 years is the right outlook. We should think about, well, what is the right long-term solution to, say, the AI arms race, right? And I don't see any other, successful, peaceful, long-run outcome that doesn't have some type of cooperative, open sense of information and mutual trust between the countries. And this type of short-termism, battling it out, only sort of leads us in a race to the bottom towards that goal.
Pretty much echoing what Eric Schmidt put in the Times piece pretty recently about the U.S. and China needing to work together on AI.
I did not see that piece, but it sounds very similar. Yeah.
Okay. All right. Andrew?
I think there are one thing I'm very interested in is the link between lobbying, so the power of corporations and geopolitics, because I think so far corporations have been a little bit short-sighted. It sounds like they've tried to use the tools they have to influence, especially U.S. policy, and they've been successful in the short term. But I think the risk that all of you are discussing is the risk that these tools are incredibly powerful toward allies more than enemies. And so what might be happening in the medium term is that the world becomes fragmented. This is clearly not in the interest of U.S. business, in the long-term interest of U.S. business. So I would be interested in trying to see how that evolves in the next 2 years. And I have some optimism that they will realize that this is extremely short-sighted, and they may try to come back to that, and they may try to rethink, especially the importance of alliance.
Lauren?
I think it's very hard to predict because of Trump in part, because there is no through line, plan, strategy, vision, ideology, and it sticks. And the implementation is so chaotic, even in the short term, once you kind of think what they are ostensibly trying to achieve in the short term. And then as well, there are a lot of X factors, like just assuming there is an election in 2026, if the Democrats take the House, that could very much change the dynamic of sort of arbitrary exercise of power. So all of those things make it very hard. The things, I think I could have answered this question with some more sense of certainty or, value before Trump decided to flip-flop on the H20 chips and basically for, not even taking an investment share, just for like some cash on the table, decided to change that particular control on those chips, bizarrely, even though ostensibly he's kind of one animating thing for him and the whole Republican Party and some of the Democrats is concerns about tech competition in the
Yeah, no, it's his unpredictability and transactionalism is
who knows? Plus, he seems to have some institutional inability to cooperate with anyone.
There's the narcissism problem, but that's a different conference, I think. Jesse, go ahead.
So I would say the key is that there's two different ways to practice geoeconomics. The one I emphasized here is actually the negative short-term version. It's, I always think of, if you're trying to get an entity you don't control to take an action that you want and they don't, it's, I need you to take this action that costs you $1 million. And how can I make you different? Well, I can threaten you with something that makes you $1 million worse if you don't do it. Or you can get $1 million, be $1 million better if you take it. Either way leaves you indifferent. However, knowing that this is going to be long-term relationships, if the way in which I am extracting from you is every period say, I'm going to take something away from you unless you do what I want, the incentive of the entire world is to insulate yourself from that threat going forward. And so, yes, you can extract today, but there will be nothing left to extract in the future. And so the way in which I view a lot of what the Trump administration is doing is that, the international economic architecture was set up with rules such that if the U.S. deviated one time, there is a lot of surplus for the United States to take. However, over a long period of time, if everybody knows that the U.S. is simply going to be extracting period after period after period, that desire to insulate yourself from the United States is going to leave no surplus left. And so while I wish the U.S. was a purely benevolent global planner, the kind of hope is that a self-interest in the United States might realize that some of these international rules and institutions that constrain it may actually still allow it to extract a little bit more over the long run than this kind of one-off, I'm going to destroy the international order and take everything now. So I'm hoping that we move a bit more towards a positive sum. Let's make other countries and firms better off by staying with us, and yes, taking a little bit as a result of it. Then let's make everybody completely indifferent to whether they maintain the relationship, but take everything now.
Okay, I have so many more questions, but I want to give folks a chance. We've got time for maybe 2 or 3. Let's start here.
I have a question for this. I mean, based on this analysis, what is the evidence of increased investment, decision to increase investment by firms, or not, or there is no real evidence of that? And perhaps with the China versus the U.S., I mean, there was not the reference to research and development spending, but see, the U.S. introducing research and development, while China is not, and maybe it's increasing. What is that in the balance between China and the U.S.? What is the effect?
Who wants to take that? Jesse?
Just on the specific, so for the increasing investment, you do see firms that are targeted saying they're increasing investment, but I don't necessarily want you to think that that's a net positive of the policy. And so NVIDIA is the perfect case. NVIDIA, the US says no A100s, no H100s going to China. They say we are investing money to develop the H20, which is exactly at the threshold of the export controls and epsilon worse, and they develop new technologies to let you link them together. It's investment. They're expending money to do it, but it may be diversionary investment. And similar could be for R&D. If the extent to which in text we can see whether the research and development of SMIC, the Chinese semiconductor manufacturer, is it actual R&D to push the technological frontier, or trying to inefficiently duplicate existing technology that would have been there? That we can't see with text yet. I think that's the big question.
Question here.
Thank you. I have a question for Clement and for Jesse that I'm going to try to weave together. So apologies in advance if I fail. But Clement, I took from your research that there is kind of this middle class of jobs that is susceptible to AI, but differentially. So while we might see automation of financial services, high-wage jobs, we might not see automation of plumbers, which can be low-wage, but are not always. But bank tellers are this middle-class job in the South, largely held by Black females, who it's like their path to the middle class, and they are extremely susceptible. I think Brookings just had a paper that showed they are the most susceptible to automation. And so what we might see is this complete loss of middle-class jobs and this real bifurcation as a result of AI. And then, Jesse, I think you showed that large firms are able to eat the tariffs in some way. They're able to maintain their profit margins or, optimize their supply chains away. Smaller and middle-sized firms are unable to do that. And so isn't the upshot of kind of both of these economic transformations larger power consolidation, which may increase lobbying, but it strikes me that's the real risk here, is that both workers and firms, you just have this complete consolidation.
So one thing I should emphasize more thoroughly in the presentation is the fact that where we are now in terms of, so what AI allows us to become much more productive at are current services that are very costly and are very, they're seen as luxury goods for most people, right? And so what that means, just like we saw when automobiles were luxury goods back around 1900, is that as these costs come down, it's not just because we're not just going to have fewer people doing those jobs. We're going to want to consume a lot more of those services. So these are not going to be sectors where we're going to have fewer workers in the immediate future, because we're going to want to scale up production. Jevons paradox is the famous a reference to that concept. So, I mean, certainly there are going to be some low-skill jobs that are going to disappear, like you say, the bank tellers and so on. But broadly speaking, what AI allows is for a lot of these, perhaps even lower-skill jobs, to become much more productive if they can use these tools. And so you say, well, some middle-class jobs are going to disappear, but other lower-skill jobs could become middle-class jobs as a result of AI.
So I'll add, honestly, from the process here. What would we have had to do pre-AI? We have 800,000 documents. It's a 45-minute call each. We have 155 columns. We would have hired someone online to read those. It probably would have been around 800,000 hours, so we wouldn't have done it. So now there is absolutely nobody at the level of reading the documents, but we have trained research assistants to run that process. I think whether that leads to concentration in the long run or this type of analysis and these type of activities that would not have been feasible without this technology, I honestly don't know.
Okay, final question, blue shirt, right there.
This is for Andre. I wondered, looking at your model and your results, whether those outcomes don't fit actually also a different hypothesis about what's going on. And that is that government is acting, that there's a protection racket, that the government is in fact acting like the mafia and extracting. So when firms merge and put their head above the wall, they can get exploited a lot more exponentially higher than on a linear scale. So I just wondered whether, well, I have experience seeing that kind of stuff done, whereas your hypothesis that you're validating is slightly different. So I just wanted to test the argument.
It's a really interesting question.
That's a beautiful question, and you hit on something that we struggled with for at least a year. This was the objection we got. Let me repeat the objection. It's not that when a firm becomes bigger, they try to exercise more. It's just that we live in a world where these big firms are targeted by these greedy left-wing politicians. And so if you become large, you have to defend yourself. And how do you defend yourself? You hire lobbyists. It's everything I showed now, it's perfectly consistent with that story. So we struggled for a long, long time with that. When finally someone pointed us to the work of your co-author Hassan, Tariq Hassan, and I'll keep it short, but he does an amazing analysis of political risk as perceived by firms. He looks at earning calls and he sees if CEOs are worried by being exactly targeted by the political system and creates an index of that. And what we find is that after a merger, so if your story was correct, after a merger, you would see that index go up. In fact, it goes down. So this is consistent with the story that a merger makes us politically more strong, not politically less strong. And so I think we can now rule out this story.
Okay, well, sadly, I'm going to have to wrap it up. I actually have to run, but we have another presentation and some final words. This was fascinating. I'm going to hit everybody up for their slides because I'm a heat-seeking missile for column ideas. And this was a terrific presentation. I think power exists. That's what I take away, and we have more work to do to control it. So thanks so much.
All right. So I'm in charge of the closing remarks. I had a good professor that once told me, "You will realize that you're becoming old when you start to do the opening and the closing remarks." And that's been happening more often to me. And at the age of 42, I'm not sure that's how I want to feel, but I'll try. First, let me thank you all for coming, for making this event. I think we had amazing discussions, enriching. We learned a lot from the panels we had yesterday and today. We greatly value the effort you made to be here, as we always value to be part of the community that we are. And let me thank especially those that work for making this happen. Savannah and Gabriela. As well as the rest of the team, Leila, Caroline, Nola, they're here and we're helping us in this event. And some of you were not at dinner yesterday, but Joe, shared the acknowledgements for everything that's been done over the last 25 years, organizing from Sant'Anna's role, who was a co-president of IPD for a decade, the role of Jared Spiegel, who's still here, sorry. Akbar, where is Akbar? Akbar, you are a maestro. I've seen you organizing the Asian Premiership School with IPD in India, leading hundreds of students. I've seen your work over the years, and you've been fantastic to our community. So also thank you, Akbar, for that. and to our partners, the ones that help us make this event, but also part of the life that we build from here, especially Kevin Gallagher and the team from the Boston University Global Development Policy Center. We do a lot together, and we do a lot, and we're grateful for that, Kevin. And I hope we continue that partnership. Same with the CEPR, Mark Weisbrot, and the team, great partners, as well as all the other partners. Giovanni, Andrea, were part of the task force in the past. We have benefited enormously from the work together. So it's been 25 years. I want to use this opportunity to focus on what comes next, what we expect to do, at least in the near future, so you know, and hopefully you can contribute to these efforts as well. So let me begin with the themes. There are two broad set of themes, the international ones and the domestic ones, on which we plan to continue working in the future. When it comes to the international issues, we are doing work, of course, as you saw in this conference, on the international financial and monetary system. And we have the view that the system is not apt for the goals that it's supposed to follow. It's actually failing developing countries. Recently, working with the Vatican, we produced a report. So Pope Francis commissioned a Jubilee Commission. Many of the people present in this room are part of that, and we produced a Jubilee report that offers our views on the workings of the international financial monetary system and how it will be reformed to enable financing for development. In the 70s, there were two big shocks for the economy, for the global economy, that were discussed in this conference. One is the end of the Bretton Woods regime, and the other, by the end of the decade, was the change in the organization of the Chinese economy. And both of them had significant consequences for how the global economy and the global society get organized. But when it comes to finance, all the dismantling of the capital account regulations led to the system that Brad described in his talk, in which we have pro-cyclical capital flows for the developing economies and counter-cyclical capital flows for the advanced economies, which makes it development economies that are inherently unstable, even more unstable. It creates larger inequities in the economy. And that we see that as an important driver, of course, not the only one, but an important driver of the outcomes we have today. Certainly, we have a more unstable world. Since then, there was only one large balance of payments and sovereign debt crisis since the end of World War II until the end of the regime of Brazil. And since the 70s, we had many crises around the world. So we will continue working on these issues, and I'll tell you how. Second, we will continue to work on international taxation, joined with ICRIT, the Independent Commission for the Reform, I don't know who came up with that name, the reform of the international corporate taxation system. Yeah, I guess it's not easy to name such a commission, but our work will continue tackling the problem of tax avoidance by the wealthiest, by the international corporations, and the constraints that they entail for the states that add to the constraints that the financial system also entails. In the panel this morning, we were discussing, Marilu and Shari mentioned the problem of the debt and development crisis in the developing countries. But we have many economies that are not going through a debt crisis today, but spend a very significant amount of their budget in interest, and they fear market enormously in a context of open capital accounts. Like, for instance, Brazil, that spends 7 points of GDP on interest and has a primary deficit of only 0.5% of GDP. But when you look at the internal debate, a lot is concentrated on the problem of the primary rather than on the interest. So all these issues come together. They put enormous constraints on the states for development. that has to do with our mission of contributing to a global society where societies can thrive, can develop. So we will continue working on both of them together. And finally, there is a third big issue that we want to reframe the debate on international trade. We want to reframe it in terms of the international architecture for knowledge creation and diffusion. Understanding that trade is a means and not an end in itself, and including critical questions today that like digital trade, data, and how we think about this architecture for enabling societies to learn, for creating learning societies across the world, rather than having a system that favors a few at the expense of the others. One of the panels yesterday focused on the issue of international trade and the rules. What has happened in the last decade to developing economies is quite dramatic. And we were told that, for instance, we could not do industrial policies, we could not do subsidies, that there were rules. But when those rules no longer favor the powerful that determine the rules, they were completely abandoned. So this goes at the core of including power into economic analysis. How do we live with the issue of power? And once we recognize that power is of first order importance, the questions on what rules to have may change. So first we have to ask the question of whether we want any rules at all, if there are going to be only rules applied to the less powerful and not to the more powerful. We don't have the answers yet to those questions, as to many of the questions that we addressed, but we hope to come up with better answers over the next few years. At the domestic level, we will continue giving attention to the issue of macroeconomics. For years, we have tried to understand how the system coordinates, how the system under certain circumstances delivers stability, but under circumstances produces instability. How expectations affect the workings of the system, how information also matters for the adjustment of the system, and particularly something that Bruce was referring yesterday, has worked with Joe for many years, how the system behaves in the presence of large changes. How are the mechanisms of adjustment in those situations? Very important questions still unresolved in the state of the field. And of course, the issue of inequality, parts of the discussion today, aim at the issue of whether, how much globalization matters for understanding the outcomes that we have today in terms of distribution of income and wealth, and how much technological progress matters. And of course, the consequences that these processes have for the workings of societies and for democracy. So we expect to continue working on that as well. How do we do all of this? There are basically three strands. The first one is the academic strand. So we do academic research, and we do workshops in which we learn from your research. We all learn from each other, and we publish volumes. I think we published about 50 volumes already in the 25 years of IPD. And IPD hosts a journal, as Joe explained yesterday, the Journal of Globalization and Development, that is edited by Kevin Gallagher and Jeremy Ocampo. And this is an important part of the process. Communication is important, so the publication is critical. Second, we have a policy engagement span. This takes a lot of time, but we think it's so important for the question on the future of think tanks. It was part of our fourth panel yesterday. I believe it's so important to go beyond just research. If think tanks want to achieve something, and policy engagement is so important. This is something that Joe taught us, and we basically we follow him. We organize dialogues, policy dialogues, workshops with governments, multilateral institutions. We think this is a critical part of the overall program to achieve the mission we have. And of course, this is totally associated with the issue of power. The powerful can make the life of the non-powerful quite difficult. But I feel that sometimes we do make the life of some of the powerful a little bit less pleasant. I may have a few anecdotes. Actually, let me tell you one of them. This happened when I was in government in Argentina and I was leading the debt restructuring of the country in 2020. An IPD coordinator, meaning Joe, a letter of experts supporting Argentina's restructuring efforts that was signed by more than 150 experts, many sitting here today, including 4 Nobel laureates, one undersecretary of the U.S. Treasury for International Affairs of the Republican government. So it was a quite diverse group, and it made it to the headlines. It did matter because it sort of contributed to change the common sense on what needed to be done. And these negotiations are featured by enormous asymmetries of power. And I got a message from time after from the negotiator of one of the largest bondholders of the country, one of the largest investment funds in the world, asking the following: Minister, is there any way you can send a message to the people from the academia that you recruited to support your proposal, telling them that the process is on its way and it's no longer necessary to comment on the issue? So this is the kind of thing that IPD can create. And finally, the third strand is communications, which is, again, absolutely essential. And we make efforts on that front as well, trying to communicate what we do in the public sphere. And we have learned a lot from Annie in this respect. We also have some special events. Of course, this IPD 25 years is a kind of a special event. I can name quite a few, but I remember one when Kaushik mentioned Arrow's paper, Cautious Case for Socialism. That was the Arrow lecture. That used to be done right here with Ken Arrow. Joe was in your doctoral dissertation familiar, right? Or he was, you studied that. And he was a Columbia alumni. So we used to organize an Arrow lecture every year where a speaker presented either a paper, it was actually the Arrow lecture, and then Ken Arrow would comment in the lecture, and then we publish a book. And we then were going for dinner right here on the 15th floor and having a chat with Arrow. And I remember once when at dinner he said, like, he was lamenting the situation that when he thought about what it came to be the fundamental theorems of welfare economics, what he wanted to show is that the assumptions needed to be so extreme that basically never have a situation in which the market economy would deliver the most efficient results. He wanted to show the impossibility for the market economy of delivering the efficient results, and then we went in the way of trying to get as close as possible as to the Arrow the group framework. Of course, Joe developed a branch of economic theory that showed that we never get there. But this is the kind of environment that IPD created, that Joe created, and it's a very rich and special environment. So let me close with that note. It's Joe and Anya, and it's also Joe and Anya are IPD. And they created a sort of belt epoch for our community, in which this is a learning environment in which there's respect, there is a humble attitude of always listening. I always see that in you, Joe. You give your undivided attention when you speak to someone, and that's so good. And that fosters a culture, which is quite, I wouldn't say unique, but it's quite special. So, of course, I believe we'll go on. And the world is different today than 25 years ago. Technology is very different. The global economy is different. China has a role that didn't have 25 years ago. We adapt and we do work that responds to the circumstances that we have, but this work is based on the same principles that I've seen since I joined 13 years ago, and that I have no doubts were the founding principles of IPD. So I look forward to see, maybe not you, but your students in 25 years. Hopefully with Joe, I have no doubt Joe will continue leading with the same level of energy. And thank you so much for being part of this, and let's go on with this. Thank you.